to learn about proven models and strategies of setting up and running business incubators, including how to engage with investors. So we have a total of 4 sessions. The first 3 sessions already took place in November and earlier in December. So we had our first session on introduction to incubation and ecosystems, and then business model canvas. And then the session 3 and session 4 really focus more on engaging with investors. Can you please go to the next slide? Thank you. So again, to give you an overview, so all of the 4 sessions took place between 2 p.m. and 6 p.m. EAT time. So they are 4 hours long and take place on Zoom. And for your information, so we have shared the materials of the previous sessions with the participants, but we also publish the recordings on our project's YouTube channel and on the website. So in case you missed the previous sessions, please feel free to consult them. So just to introduce you again to our expert trainers. So the first 2 sessions were delivered by Susana Seabra, Douglas Thompson, and Francisco Rocha, representing SPI, a consultancy firm in Portugal. And the last 2 sessions are executed by Francesca Natali and Lorenzo Valeriani from Meta Group. Lorenzo will be indeed leading our session today. Next slide, please. So just a few words about EBN. So indeed, EBN is the coordinator of the BIC Africa project. The organization itself actually started as well as a European-funded pilot project with the ambition to create a network of incubators of high quality, mostly in Europe at the time, that could support entrepreneurs and startups, mostly those indeed who focus on innovation. So actually, EBN designs, develops, collaborates, and delivers a wide range of technical business support services and also quality assessment and certification products. So one of the specificities of EBN is that actually we have a certification scheme for our members, meaning that the aim is to create sort of a quality brand that serves as a proof to entrepreneurs that the services they are engaging in with the business incubators, these specific business innovation centers, are of standard and high quality. So this network of EU BIC centers, as we call them, they offer really services that with the complex spectrum of entrepreneurial innovation support. So their services include incubation acceleration, internationalization, access to funding, and other various components. Next slide, please. And now I would just like to give you a short introduction on BIC Africa. Also, if you have missed the first session, as I said before, there is a recording of it. And in the first session, we went in a little bit more detail. So if you would like to have more information, please feel free to view that session again. So to just give a summary about BIC Africa. So indeed, we are collaborating together with 5 separate country projects. The aim of each of these projects is to establish, consolidate, and reinforce business incubators in their respective countries. So as you can see here on the map, these 5 countries are Angola, Comoros, Ethiopia, Madagascar, and Somalia. And each of these projects are led by different implementing partners. So in the case of Somalia, Madagascar, and Comoros, the implementing partner is UNIDO. In the case of Ethiopia, it's SEQUA. And in the case of Angola, it's IFC. And us, so BIC Africa, our aim is to create really a regional network with dedicated capacity building and networking support, and also software networking services for the wider incubation ecosystem in the region. So we create synergies also among these 5-country projects, interconnect them, and yes, provide additional services as well. Next slide, please, Lorenzo. So just to show you the beneficiaries of the BIC Africa project. So our direct beneficiaries are business incubators, and indeed mainly the business incubators within the 5-country project. Whereas the final beneficiaries are the entrepreneurs, SMEs, and startups who these business incubators are essentially supporting. But nevertheless, we don't really directly work with the entrepreneurs, SMEs, and startups. Our focus is really reinforcing the capacities of the business incubators. And there are a number of other beneficiaries who are also indirectly involved in our project activities. So these vary from policymakers, business angels, universities, EU delegations, and so on. Next slide, please. Yes, and just to give you a short overview of really the kind of service offer that we have for the business incubators within this 5-country project. So we have capacity building and skill development services. So this includes the virtual training center, of which today's session is a part of. This also includes 5 national and 2 African on-site boot camps. So these are boot camps that we hold live with the business incubators from the respective country projects. In case of the African one, we really gather together these business incubator managers from the different countries and hold training sessions for them collectively. So we also help these business incubators making a better connection with European as well as other African business support organizations. So starting from next year, we will have what we call the soft landing services, whereby business incubator managers from these African countries will be visiting and learning about organizations, actually certified organizations in Europe, and staff exchange program, whereby, for example, a business incubator manager from Ethiopia would visit another organization, for example, in Comoros or in Madagascar. And then we have what we call the certification scheme. So as I mentioned before, one of the core services of EBN is the quality certification. So in this case, our aim is to also certify African business incubators regarding their services and the quality of the services that they provide. So of course, in this case, we adapted to the context of each of these countries. And finally, we have some other services, such as also connecting entrepreneurs and business incubators to diaspora members, also awareness raising and helping them explore other business opportunities. So just in brackets, as I said, the majority of our services are targeted at those business incubators that are directly involved in the country projects. But for example, there are some exceptions, like the virtual training center today, which is open to business support organizations from also other sub-Saharan African countries. And so it is not limited to those business incubators that we normally work with. And there are also some other programs, such as our acceleration program for female entrepreneurs, within the scope of which we actually run an acceleration program for females, generally from different sub-Saharan African countries as well. And that goes through an open application. We will have our next program next year around spring. So that's just a short overview. And Lorenzo, if you could please go to the next slide. And yes, so here we just to represent again the core team. So Robert, myself, and Dawi. If you have any questions, please feel free to message us. And now I would like to hand over to Lorenzo Valeriani, who will be leading today's session as mentioned before. Thanks a lot. Thank you, Lorenzo.
Thanks, Christina, and again, good afternoon, everybody. Nice to meet you all, and nice to see you all for those that participated in the last session. Now, starting a little bit for clarifying why here today. So, just to follow a little bit what we discussed in the last meeting with Francesca, the main goal of these two sessions that are linked to be ready with investors in terms for a startup to be engaged successfully with investors. We would like in this specific also session of today to be focused on helping you as director of incubators, expert in incubators, part of acceleration program, part of also technology transfer team in universities or another organization, to be ready in supporting your startups in increasing the investment readiness, which is a crucial point, especially because all high growth startups, let's say, they will need money to grow, to fuel their growth. And so you as support, you need to be able to do that. So also just to continue what Francesca did in the last session, today we will focus again in giving you tips, insights on how to be ready to support properly startups in increasing the investment readiness. So the main topics of today basically will be 3. Understanding properly the due diligence process. Maybe Francesca already touched this point in the previous session, but we will see that this is an important, let's say, moment for each startup when they are starting the due diligence process for a potential investment with investors. And from a perspective of a coach, of an expert, that you need to advise startup, it's important that you also understand clearly how this process works and how you can give tips and insights to startups on how to succeed in going through this, let's say, painful process. Then a big insights on the difference, the main differences, let's say, between the due diligence that are run by the main 2 risk capital investors in the early stage, business angels and VC, venture capitalists. Francesca already mentioned this difference, but maybe for those that were not there in the previous session, I will just, when we are going through this topic, explain the main difference also about these 2 financial stakeholders. Then another important point is relevant metrics for startups. What does this mean? When investors are going through due diligence process, when investors are approached by startups, it's important that each startups, for being ready for a specific level of investors, they need to be ready in providing crucial KPI metrics for being considered as potential investment. A lot of time, we'll go through this when we're going through the specific slides, startups, when are approaching investors, they are not aware about the fact that maybe that investor is looking for a specific metric, for a specific level of metrics, KPIs. And you as support, you as coach, you as expert, need to understand properly this point on guiding startups to working around specific metrics and KPIs, especially in the early stage. So again, these are just to a little bit refine the main topics: due diligence, startups metrics. So the experts, you already knew Francesca from last session. So about myself, just to briefly introduce my experience, I've been working for Meta now for the last 8 years. I've been involved, let's say, in the different areas of Meta since the scratch, but in the last 5 years, I've been focused more on the academy and startup support. At Meta, we have, you know, both a academy focus area about, you know, division, where we are supporting researchers, startups in taking their results, their solution to the market. But we have also another focus area, which is the investment area, where basically in 2010, we started as one of the first operators in Italy to invest as risk capital investor. We invested now across Europe in more than 80 startups in the early stage. And I was part of this team in the last 5 years as analyst and supporting the directors, the funds directors in supporting and reviewing startups' execution plans in order for them to grow and to succeed in their journey. So very happy to be here today and share all the main insights about, you know, the due diligence process and the startups metrics. Before starting, as we did last time, I would like to a little bit better understand who is in the audience, who are you, and basically which are the main expectations for today from your side. So just a little bit during the presentation to align better the content and so on. So for making this, let's say, ice-breaking session, we are using Slido. If you are part of the last sessions, I think that you are acquainted about Slido now. But in case for those that you know, never use Slido, you can use or your smartphone, your laptop. For the smartphone, you can take your camera on and go through the QR code, and then you will be directed to the link. Otherwise, if you're going through the laptop, I kindly ask you to go through the specific slido.com website. So I will type also down in the chat. You have slido.com, and then put the specific, let's say, code, the figures that you will find below in this slide, 2536614. So I hope that you are managing to connect to Slido. So the first question is, you know, to understand, you know, which kind of organization are you working for? So, okay, there is someone working in the university. So maybe from Technology Transfer Office, Business Incubator. Okay, very nice. NGO, university. Okay, it's very, you know, diversified audience. Incubator. Okay. Then I see that other participants. Okay, so universities are taking the lead at the moment. So, okay, so maybe also the final exercise will be something very useful as university, because we are focusing on a business case from a research project from university. Incubator, okay. Oh, very nice. Incubator for women entrepreneurship support. So, okay, incubator. Okay, so we have basically universities and incubators for the most, as I would say, the most two representative organizations for today. So I see a last participant that it's, okay, typing down, okay, university incubator. Okay, so maybe there is last one. So just before moving to the next, you know, question, we were just waiting the last typing before moving. Okay, university incubator. So, okay, we can say that the most representative one are incubators at university. So I think that the final exercise today would be, say, very fitted and appropriate for those organizations. Okay, so which is your role basically in this organization? Are you director? Are you part of the, you know, experts coaching, community manager, director, trainer? Okay, directors. Okay, very nice. Coach, sub-grant officer. For the most now we have directors, instructors, so trainers again. Okay, business incubation coordinators, program manager, directors. So, okay, we have directors the most, so very nice. Okay, so we can say that the most representative one are directors. Then we have a lot of people coming from incubation program as manager, but also as coaches. So that, again, I hope that with today also directors will take a clue about, how they can advise also their coaching teams as, supporting better the startups around this, I would say, hot topic that is investment readiness, that are crucial again for maybe the success also of an incubator. Because if you're looking at the best practice at international level, especially if you look at the United States as the main market in, this innovation ecosystem, Silicon Valley and whatever, there is Y Combinator that maybe you heard, which is the leading incubators worldwide. I think that one of the main success, the KPI that maybe as director you are taking into consideration are the successful startups that you incubated, and how you're measuring this. Basically, the fact that they raise a lot of money, they become public, they are worth now in the stock market billions. So, and this coaching today, I think that it will be very relevant, because if you are working together with startups in this perspective of investment readiness, then you will have startups that when they are going out of the office in the incubation process, they will be successful in raising money, growing, and succeeding. So, which are the main expectation for today's session? So just to understand from your side about the due diligence process, startups metrics, which could be the main, expectation or expectations that you may have. So after you are going at home today, what would you like to learn when it's 6 p.m. basically? Okay. Understanding red flags for investors. Okay. Risk assessment. Okay, we will see also this. Investment readiness, financial sustainability for startups. Okay, so we'll review this concept. So someone else that would like to share its personal expectations. Otherwise, of course, we will take a look at the risks assessment in terms of due diligence, which could be the main red flags. These kind of red flags we will see in the exercise in the last part of the session, in the last hour, okay? Engaging with investors, of course, and then, of course, the concept of, being financially sustainable for investors. Okay. So, I don't know why there is this kind of program coordinator slide. Okay, just give me a sec. Don't know what happened. Okay. I don't know what happened, honestly. It's program coordinator. I don't know what happened. Maybe I will stop sharing and I will stop and we'll share again, because I don't know what happened with the Slido. Sorry for this technical break. Okay, so I hope that now you can see again my presentation. So I hope that now you can see without, the pending reply that was in the slide. Okay. So as I was saying before, the structure will also embed the interactive session in the last hour. The 3 hours before we will cover more, let's say, theoretical session where discussing topics, insights. And basically what, as we discussed in the last session also with Francesca, we would like to have an interactive session. Please use the chat to raise your questions, okay, in order for me to address them properly. So do not be shy, meaning that if you think that your question is stupid, trust me, it's relevant for also a lot of people. So whatever kind of questions you may have about the topic, please write in the chat. The agenda. So after this, let's say, introductions part that we had, I would like to focus on the first part of the diligence, have a coffee break more or less in 40 minutes maximum, okay? Then starting again with closing the due diligence part and finalizing the startups metrics concept. Then having a coffee break at 4:45, and then start again at 5 for the interactive part, okay? For making this exercise where again, some of you wrote red flags from investors, and in this exercise we will see in a business case which could be some red flags from a specific research project. Okay, so maybe we can now start with the first topic, which is the due diligence process. Again, I don't know how many of you know in detail the due diligence process. If you ever be involved, meaning in this kind of process of due diligence, or you support your startups in this kind of process. But nevertheless, just to contextualize where we are, if you join this session with Francesca, basically she presented this kind of slide where she presented the main gates that each startups needs to pass from the moment the startup realized that they're looking for money and till the end of the process, when basically they are liquidating, let's say, the investors, risk capital investors. So all this kind of training that with Francesca we are delivering, it's focused on risk capital investors. Again, Francesca explained what does it mean. So it's not about debt, it's not about grants, it's more of risk capital, equity money, okay? So looking at these stages, when a startup, you assess with a startup that they need money, a specific amount of money to grow, to fuel their specific growth, then the first thing is to contact investors. Maybe you as incubators may have a network of business angels, you may have a network of VC funds, so you can support them in scouting, which are or potentially are investors for them. What is important that at the same point, the startup will meet the investors. The first interaction, as also Francesca presented in the last session, is the pitch, meaning a short time presentation for attract the interest of investors. Usually, maybe you as incubators are running each quarter, each year, for the startups you supported a pitch session with investors. If it is the case, then startups will interact for the first time with investors in this specific context. If a startup then is raising interest from investors in this specific context, then what's happening is that investors it's having a more detailed interview with the startup, okay? And if after this kind of more detailed interview, the startup is raising more interest from investors, then investors it's launching, it's starting what we can define due diligence. So the due diligence is, let's say, a level of interest, which is very high from investors, where the investors would like to spend resources, because they are spending human resources, time, for going deeply in understanding if the startup is worth to be invested. And so the due diligence, it's a detailed assessment of a potential investment by the investors. Then after the due diligence, just to close this process of investment readiness, you will have the negotiation. After the assessment, an investor is coming with a proposal for investment, and this proposal is embedded in a term sheet. Term sheet, which is a non-buy document, which is presenting the main clauses, the main conditions investors is investing in the startup. If again, the due diligence process is concluding with a green flag, meaning no specific issues raised from the analysis, then investors and the founders are converging into a investment agreement, which is a binding document, in which is specified that investors is becoming a shareholder of the company. Then the deal will be made, okay? So startups will receive the money, but then it's not closed, meaning all the process with investors, because startups must know that once they are invested by risk capital investors, they will need to live together with this investor. And this means that investors will be part of the board of directors. This director from the risk capital investor will ask for a report to understand if the startup is moving as from the plan. And then remember, as Francesca also shared in the last session, that the marriage with investors is, let's say, with a specific time frame, and on average 5-6 years, okay? And then it's expected an exit. So remember that if you are going through the arena of risk capital investors, you as founders, but if you need to advise startups, you need to tell the startups that they need to accept a certain moment to pay back the investors. And the only way for pay back the investors is through an exit moment. Usually, this is just statistics. I don't know in the African ecosystem, but at least at the European level, 85% of the exits are done by acquisitions. This means that a big company, it's buying 100% of the shares of the startup. So you are selling your startup for another company. And if your startup's founders are not prone to accept this, then maybe they're not ready for risk capital investors. Of course, there is always the IPO, which is the public offering. Again, this is just a minority of the cases where basically, again, maybe the founders are still part of the shares board of the companies, but this is just a minor event. So basically, this is all the investment readiness process. So realizing the money till the exit moment, and this is again risk capital investment readiness process. So I hope that this kind of, let's say, flow is clear. If not, please, or if you have doubts, write in the chat. Now I would like to go through in detail about the due diligence. Okay, these are just some statistics that maybe you would like to know, that about 100 startups, business ideas that you are coaching as incubators, once they are going to investors, to risk capital investors, just maybe 1 or 2 are raising money. Okay, these are statistics, rule of thumbs, but just to say that it's very hard to go through past all the main processes, pitch, due diligence, for succeeding and raising money. Okay, and startups need properly assessment support in order to survive. So what investors are looking for. So this is the main question that you as incubators need to go through with the startups when you are supporting them and say, okay, you need this amount of money for the next 1 year for reaching this milestone. So how you can raise this money? Which are the main let's say shareholders, financial shareholders you can contact? You need to know as incubators what is the expectation of risk capital investor. They are looking for high growth venture startups, meaning startups able to increase their values in 5-6 years with a big, I'm saying big multiple. Usually, this is a rule of thumb. When investors, risk capital investors, putting money into startups, in 10 startups, only one, I'm saying only one, it's paying back all the money invested. Plus, this startup, it's able to generate also return for investors. So when investors are investing, they're looking for startups that can grow 30 times in 6 years, meaning the value recognized by other investors, by other buyers to these startups after 5-6 years must be growth of 30 times on average. So you can understand that not all startups are able to succeed in raising money from risk capital investors. Amazon, for example, was a good deal for risk capital investors. Why? Because, Amazon was able in growing revenues billions in 5 years in a, let's say, big multiple. So as you see, this kind of high growth curve must be something that you need to be sure that the startup that it's looking for risk capital investors, it's able to generate. Because again, if a startup, it's a more standard business model with a flat curve of growth, but always this startup will become profitable, maybe you need to say that they are not the perfect match with these capital investors. So this is important for you to know. Not all the startups are high growth companies that are, let's say, interesting for risk capital investors.
Lorenzo, thanks a lot. There is a question in the chat.
Yeah, please.
The question is, what exit strategies exist and which are more important and profitable for investors and startups? So I think meaning from investors and startups point of view. Thank you.
Yeah. Well, again, as I said before, just that in Europe, 80% of the time, 85% of the time, there is an acquiring company coming and buying 100% of the shares of the startup. This is the most, let's say, frequent ways. Again, in terms of, which is the most profitable way, I would say that if a company, a startup, it's generating a good momentum, I think it most depends the ways in which area you are in. Of course, if you are in the United States, maybe the IPO, the public offering, is something that can generate a bigger return. Because maybe if the market, again, I'm just giving you a specific context, if the market is in a bull way where basically everything, the investors are crazy, are buying new startups, new shares coming from technology and whatever else was in 2000. If you were a startup in the internet space in 2000 and you are making public offering there, it was the best way for your startup to exit, because from the first price of acquisition, after 1 day, maybe the pricing was 100 times bigger. It was so. If you were an investor and you invested, 100,000, then with after 1 day, your value was 10 million maybe. But it was not always like this, meaning that also if you are acquired by another company, then of course it is more an acquisition from just one stakeholder, not maybe a big audience of investors are in the public market. Well, again, I would say that both of them could be profitable. You need to, first of all, to understand if the startup, where it is, which is the most frequent, let's say, way to generate an exit, at least in Europe, we said acquisition. And also the sector, maybe more sectors are focused on, for example, the biopharma companies are more prone to have acquisition. So I'm thinking about big companies like Novartis, Bayer, Pfizer. They're quite a lot buying existing startups because they need to use them in the pipeline for their research, and they're usually paying a lot for them. So again, sector, the country, take a look at the statistics. But as I said, all the ways for exit are profitable. If it is a acquisition, if it is an IPO, then of course there could be buyback, but this is very rare, where basically existing shareholders can buy the shares by the investors. But usually it's very rare that existing shareholders can, define a big value for investors, because again, it will be, this usually happens when the startup it's not going so well and investors can accept also a multiple of 1.5. But if you are looking for succeeding exits, is acquisition or IPO. So I hope that I replied the question. Okay. So going again through the slides. Again, it's as I said, it's for investors. What is crucial? This is always put in the head of investors. Investors would like to select the companies carefully because, as I said, if investors are investing, risk capital investors are investing in 10 startups, only one is generating the profit for all the investment. So they are selecting carefully, and they are making this process of due diligence very carefully because they would like to assess if a startup which raise interest from a pitch session is the right investment. Okay, and the due diligence, it's fixing the rules of the game through the term sheet, the main conditions, and the shareholder agreement, where basically is the translation of the term sheet in the agreement between the shareholders. Of course, lucky factor, it's always an important variable to take into consideration, because maybe in that moment, investors are looking for a specific portfolio company with a specific profile, and you are the right profile to be invested in. Maybe you are contacting investors which can invest in you, but they already have another similar company in their portfolio, and they are saying no. So lucky factor is also something that can affect as always. So what is due diligence? So we already defined before that it was a sort of deep analysis of the startup. In this slide, you have the proper definition, but just to summarize again, a deep analysis of the startup by the investors. Why they're doing this kind of deep analysis? Because they would like to be sure that all the profiles of a startup are aligned, are promising, and this analysis it's helping the investors to de-risk the perception of the startups that this investment is risky. So basically, due diligence, it's kind of making sure that investors are not perceiving as much as risky as before the investment. The goal is that all the information that are provided by the sellers, by the startuppers, the owners of the companies, are true, and there is no specific, let's say, surprise, because a lot of time, when you're interested in a startup after a pitch session or a one-to-one face interaction, then some information is not, disclosed. In the due diligence, everything is disclosed, and then it's coming up that maybe there is an issue with the tax, authority and whatever. So due diligence is just to make sure that everything is clear, the startup is promising, and basically this investment could be the one that investors will generate the return for the portfolio. So there are different levels of due diligence. The due diligence process, it's all the process, but there are different levels depending on the areas of investigation we can go. Legal. So maybe, I think that there are slides, with the detailed, just let me check. Okay, so there is the legal one that especially for health startup, biotech, or startups with the deep tech are crucial, because maybe the startups have the asset, the IP inside the as in the asset. So it's very important that investors understand properly who owns this asset. Tax, again, usually if startups are incorporated by a few years, there should be no problems, but it's always important to understand if there are issues with the tax authority. Operational, taking a look at if the startup, it's another startup, especially what is the facility, if the facility is aligned with the regulation or whatever. Then financial, so looking at the financials of the startups, which are the expected growth of the startups, the expected revenues, when there will be the break-even in case. Environmental, which is something very now crucial, especially if the startups, it's solving a circular economy challenge or challenges. What's happening now that there are impact investors. These impact investors are taking more care about this aspect in their due diligence. So they are taking a look at how many kilograms of CO2 you can save in 2 years, 1 year, these kind of metrics. And again, this is a very important due diligence. HR, so all the analysis, who are the shareholders, who are the employees, if any, who are the advisory board people, if there are any problems with the law or whatever. So understanding of the people behind. Because remember, Francesca stressed this point last time, in risk capital investors, when they're investing in the early stage, they are investing not in the idea, but in the people, in the team. So that's why the due diligence about the team is crucial. Again, these are some detailed steps that we already discussed before. Usually, again, introduction, pitch session. Then if after the pitch there is an interest, usually there is a start of more detailed one-to-one interaction. After this one-to-one interaction, there is a term sheet signed. So basically investors say, okay, we are interested in your startup. These are the main conditions. But then there is the due diligence, where basically investors are asking a lot of documents to founders. There could be site visits if, again, the startup is hardware company with the facility. There will be interviews and especially there will be a data room that, again, is very important maybe as business incubators. Startups, when they are fundraising and if they are looking for risk capital investors, you need to support them to set up as soon as possible a data room where it's a virtual space where all the main documents will be saved for investors. And you will share as founders this data room once the due diligence will be starting. A big tip that you can give to the startups is that the more they are prepared to share documents, to have documents updated, to have everything well ordered, the better and the faster the process of due diligence. We invested in different startups, and basically we have two kind of profiles of founders. Those that are prepared, that know what they need to do, data room, that if you are asking a document, they are able to send you back in 2 days maximum. And the other spectrum, there are those that are, they have data room, they are sharing a piece of information, different documents, where then it's difficult for investors to make a proper due diligence. So a suggestion is try to push your startups to be ready, to create this data room in advance, to be proactive, and to have all the documents, not only the pitch, the financial forecast, but also documents about shareholder agreements, contract with employees, if any, all allocated somewhere and saved in the proper way. Because a lot of time they need to go to the accountant, they need to ask to the expert, they need to ask. And also from an investor's perspective, this could be a sign of not, clarity, professionality, and could be a yellow flag, let's say, not red, yellow flag. But basically how I can trust somebody that is not able to have important documents saved properly. What if there is a big issue with the market, a big issue with, a potential discussion among founders? So if other important issues are coming on, how I can trust this person or this group of people? So it's important that you as coach are supporting them properly to be ready. Then final terms. So there will be a binding offer. So if the due diligence is everything okay, they're saying, okay, we're interested. Binding offer with an investment contract. When both parties sign the investment contract, basically, there will be, the secure financing, and basically there is this, check by the investors that it's going in the bank account of the startup. and then basically you closed everything. Okay. Important process, but you as support must properly, let's say, take care about the founders to create data room, even if they are not fundraising. But if you're giving this approach mindset to have everything, all the documents stored properly, then it's a very good starting point. Then, as you can see here, it's a matter of the same kind of thing we discussed in the slide before. So I would like not to go again with the same presentation. It's a sort of duplication with more detail. So this is again a rule of thumb. This is just 3 out of 4, 9 out of 10 are failing. So all the investment in startups are based on assumption, because remember that all the financial forecasts are something that are based, that are not happening usually. So what you are forecasting now, it's not happening in after 2-3 years. So the due diligence is, again, to make sure that assumptions are stronger, and especially the team that it's executing this plan, it's the one that can support properly, bear properly the process. So this before the due diligence. Okay, we discussed a little bit this. So usually you support investors in matchmaking. Those investors express interest in investing after the pitch. After the pitch, then they are meeting for a more deeply discussion. Then investors are proposing the key terms in the preliminary stage about structure of the transaction. So the equity, the price is one of the most important terms in the term sheet. How much your company is worth. Remember that in all the deal, there is always seller and buyer, and one of the most important clauses is the price and the process. So basically how structured due diligence with documents needed and whatever. In this kind of level of interaction, in this preliminary stage, there is always a term sheet signed, which is basically, there is alignment of interest between the seller and the buyer, the startup and the investors, and this is signed by the term sheet. Then the due diligence is starting, okay? Usually, there are 2 different profile of risk capital investors in the early stage: business angels, physical people, and VC funds. If we are dealing with a VC fund, usually investors have a larger team behind, analysts, interns, that are taking care about making this, let's say, dirty job of collecting documents, asking documents to the founders, okay? Once all documents are collected, okay, investors basically are analyzing these documents, okay? Usually the access to these documents, as I was saying before, is through a virtual data room. Important tip, start to create this data room as soon as possible with your startup. And another point that is important is that there is a timeline that is fixed among investors and startup. So investors are saying, we expect to close the due diligence in 2 months. But there are deadlines by which startups need to provide documents. And what I was saying before, if in this exercise of due diligence, there are delays by the startups due to disorganized approach, this is a yellow flag. So try to push your founders, your teams, to be organized, okay? So usually the due diligence, it's requiring information and receiving this by the startups. There could be a site visits, not always happening. if there is a facility, of course. If you are supporting startups that are producing hardware, this is more frequent. If the startup is software startup, maybe there is no need to visit, a room in a workspace, maybe. Then interviews with management. So, which is very important here is that investors, as I said, are looking very closely to the team. So that's why founders need to be ready also to reply the most frequent questions in this kind of interview. Again, what you need to show, meaning founders need to show in front of VC or business angels. Team, it's a group of people maybe that work together since so far. All the main areas for succeeding in a business are covered. If the team is facing a gap in terms of an expertise, a suggestion that you need to give to this team is do not lie. I mean that you don't need to say that there is a person or there could be a person. Just say that you know that there is this gap and you are working for covering this gap now. Okay, it's very important that you show that you recognize which are your weaknesses and you're doing everything in order for turning this into a strength. Okay, so another important tip is if the team that it's leading, the startup, it's based on 3 people, maybe 2 full-time, 1 part-time, and this 1 part-time is always a crucial role. You need to, again, stress your founders to say that this person part-time is turning 100% once, the investment is received. Okay? So just to say that there is a commitment, there is already a future commitment for this person to turning 100%. Because remember, if we're saying that there is one person 50% explaining and not why or whatever, then investors, are making here a yellow, orange flag. Okay. It's important that you properly support this, the team in surviving in this interview. Okay. Again, always here there is a preparation. Always important that if you go online and put the most frequent questions around in this interview, you can then have this kind of 10, 15 most frequent questions and properly support your startups in going through this successfully. Always important to not lie in due diligence process. If you're lying somewhere, then it's coming up that it's a lie, and then you are burning the bridges. So, and this is crucial, meaning it happens to us that, we then, after the due diligence, during the interview, we had the kind of information. Then after we received documents and whatever, we realized that the situation was completely different. And it was a big issue, let's say. What's happened is that we closed the due diligence saying, we are not happy to go through. And then basically, as the risk capital ecosystem investors, it's not a big community, but it's close. Then we shared with other investors these experiences. And what happened is that this startup went to other investors asking this, but investors know about this kind of experience, and then basically they struggle to find money. Meaning, if you would like to create a good relationship in the risk capital investment area as founders, you need to be transparent, open in the due diligence process, okay? Because otherwise you can burn the bridges with other potential investors. And you as coach need to properly, advise this to the teams. Then we have investors discussing the outcome of the due diligence, analyzing everything, and then starting their internal process of decision, okay? Because what happened is that depending if there is a funds or a specific business angel, what's happening is that the VC, especially the venture capital fund, they have specific formal procedures to go on. They're preparing a due diligence report for the board, and then the board is deciding if the startup is going to be invested or not. Okay? While business angels, if there is just one business angel, these people are working with their money, they are deciding for their money. So basically, the process is less formal, let's say. But especially if there are syndication of business angels, where more than one business angel is participating, then the structure is similar to VC fund, okay? So basically, there is a report based on the main outcomes from the due diligence, and then the board is deciding if going or not with the deal, okay? I don't know if there are questions so far in the
Yes.
chat. Okay.
Thank you, Lorenzo. So actually there are a few questions in the chat.
Okay.
So I'll just start with the first one.
Yeah.
So that was, how does the due diligence work for pre-seed entrepreneurs, as these entrepreneurs may not yet have many documents? So for example, regarding cash flow, maybe legal status, and so on.
Well, again, if you're speaking with investors that are investing in this kind of stage, they are not asking you documents which are related to more mature companies. If they are not, investors investing in that specific stage. So we invested quite a lot in early stage startups. So we never asked for the last 5 years of, financial reports, because we know that maybe this company was incorporated within less than 1 year. So I think that the process for the pre-seed, it's aligned with the specific stage. So what we are discussing today, it's more, let's say, early stage, that could be pre-seed as, the question point, but also could be maybe startups that are producing the first revenues and then maybe are incorporated for the last, 5 years. Of course, if you are in the pre-seed, and especially, VC and business angels investing in this, they are sometimes asking also if you are incorporating the startup in the next months, because maybe you are just a team of people that are having an idea. So of course, documents that are asked are different, especially all the documents with the employees, their contracts or whatever. If you do not have employees, you don't need to share this because you don't have it. So, but if in a pitch session, or if the one-to-one, because the due diligence is introduced only after this kind of sessions, by these sessions, I understand that you're in a pre-seed stage and you don't have employees. I will not ask you contracts by the employees. So it's important that you as incubators know that which is the stage of the startup, and then according to this, the main document. So if, again, there is a research team, then you need to prepare in the data room the business plan, the pitch. You may have the patents, maybe documents, because maybe in the meanwhile you patent the technology, and the financial forecast, and that's it basically. Maybe, I don't know, if you have the contract with the university for being host for hiring or renting the labs and the space, but no more. So you don't have more documents to share. If the startup is incorporated in the last 5 years, maybe you can have the last 3 years of financial reports. You have contracts with employees. You may have all the, let's say, if you have the facility, especially your own facility, you may have also all the permissions for the facility, the environmental permission, these kind of things. Again, if this is the case. So, of course, in a pre-seed stage, data room will not be full of documents. So I hope that I clarified this point.
Thank you. Thanks a lot, Lorenzo. And then there is another question about what types of findings of the due diligence may be of a condition for the startup to change.
Key findings. Well, I think this is something not well, usually again, it's a black or white, let's say. So because sometimes if you are in a black area for the investment, there is no way for changing something that investors that can change their mind. So it's very rare, basically, that you are in a yellow stage. It can happen where maybe, a finding that can change completely or can move more for yes or no. But again, in our experience, at least, when we received, applications and we were in due diligence with this kind of application, the due diligence was made for startups that were very interesting and where basically, the no-go was more related to the fact that on the other side, I have a better one. So it was not something that, okay, I would never invest in you, but it was more that I have another one more interesting. And a no, just let me tell you this, a no at this stage in the due diligence, if you're at the due diligence phase, it's good because you work well in the pitch, you work well in the one-to-one, you proper work around the arena of investors. Maybe, as I said, maybe the lucky factor is that on the meanwhile, in the same due diligence process, there is another startup better for that moment. So that's why if you're receiving a no in the due diligence, maybe, it's something that is not a failure, meaning that, you're doing things not properly. But maybe in that moment for that investors, there were another deal that they do better. So maybe you need to go to another one, or maybe you can come back later to that kind of investors. So again, if some doors are closing in due diligence, this does not mean that you cannot come back. But as I said, findings, if I have findings about a startup in a due diligence that say, I'm not interested, I will not change my mind as investor. But again, investors will never tell you that, they are having a better deal, on the hand. So, but again, you can imagine that, as I said before, investors, business angels are receiving on average thousands of investment opportunities each year. So if you're supporting a startup, there are other 999 startups competing for that money. So I hope that also this point is clarified.
Thank you. Yes, I think so. Thank you, Lorenzo. And there is a final question. So regarding whether a due diligence process actually should be conducted at each stage of fundraising or once for all, meaning one time, I think.
Well, the due diligence, it's run by each investor, meaning that if you are you're moving on with 3 different investors, 4 different investors, then you are having 4 different due diligence processes. Of course, I'm saying of course, 90% of these processes are similar. So the efforts can be easily duplicated for the others, processes. Of course, then there is 10% that can diverge a little bit between for organizational issues or whatever. So I think it's important that, if your startup is fundraising, there must be one person, one founder that it's 100% committed to this. Because again, imagine that if you need to share different documents, different 5 investors. As I said, you have one data room that could be fitting all the expectation of the investors, but there could be a little differences among them, so that you need to deal with more specificities, and then you can take more time. But as I said, on average, the diligence process is one for each investor. So that I hope also this question is now
Thank
clear.
you. Thanks a lot. Thank you so much, Lorenzo.
So before closing this point and then having a break, just to take understanding of the timeline, usually the main big process is around collection of documents, all the information, usually more than 1 month, okay? This is very important. So data room to be prepared. So if you have this prepared already, then you can shorten this. That's why this is a tip important for your startup, okay? Then follow-ups, integrations, or whatever. Meetings. This can take another 2-4 weeks. Then, if everything is going smoothly, finalization of legal documents, another 2 weeks. Last but not least, another week for closing everything, okay? So as you can see, it can take up to 12 weeks, 2 months and a half, we can say, 3 months. So if you are preparing properly the startups, then these weeks can be shortened, okay? Of course, do not expect to close, startups close a due diligence in 1 week. It's impossible, okay? The point that you need to stress with your startup is you need to support them, because as incubators, you can give all the right recipe to follow in order for shortening this, surviving, succeeding this. But as incubators, I don't know if you have also experts in the legal area, especially when they need, to help startups in digesting the term sheet, in taking the main clauses of the investment contracts. This is something an important point. So I think that you as directors, especially, of course, you may know this, but also expert. If you have an expert following a startup, but then you have your colleague in the legal area, please involve this kind of legal expert as soon as possible in this due diligence process to support the startup. It's important, this point, because the main clauses that you have in the contracts can affect the governance of the company, can affect the operations of the company. So do not underestimate this point. So a big tip is, if you are an organization providing also the kind of expertise, embed this support altogether immediately when the diligence process is ongoing, okay? Because otherwise, if and when documents need to be signed or need to be discussed, and if the founders do not have the proper background, then could be a tricky moment, okay? So big suggestion, support them in the legal expertise. Then before maybe closing and having the break, maybe then we can just come back briefly to these slides after the break. I would like just to say that you are opening, meaning as founders, the founders are opening up the startups to the investors. Clarity and transparency must be fundamental at this stage, okay? And there are 2 main leverages that can get easier this process of due diligence. The ability and the willingness to provide appropriate information by the founders. Because if the ability is something you can work as incubators around, providing, supporting them in preparing the documents, taking care about the specific documents, storing them properly, having update version. A lot of time when we're studying due diligence, we see business plan that were from 1 year ago. And again, could be a yellow flag. And willingness to provide appropriate information. This is something, again, you can work, but this is more about the specific person. Because if you don't want to disclose some information, it's a way to behave that it's, again, a yellow flag or red one. So you need to share this with your startups. Being prepared, organized, and being transparent for providing information at this stage. So maybe we can have the break now, because I think that we are a little bit also in delay in the agenda, but we can
yeah, thank you. I think
accelerate after. And yeah, I think that we can have from now 15 minutes. So I think that we can come back.
35, maybe we start again.
Yeah,
at
35, yeah.
3:35/1:35.
Yeah.
time.
Yeah, 3:35, we can come back and continue this. So in the meanwhile, if you have questions, type in the chat.
Hi, Lorenzo, and hello, everyone. Welcome back. So I think we can continue whenever you're ready.
Okay. So just a little bit to close what we discussed so far. So, just to give a little bit of clue of this specific area of due diligence that can run, again, depending on the stages or whatever. Financial one, that it's focused on financial forecast, balance sheet, income statements, cash flows, if existing, because maybe, again, there is no startup incorporated. The kind of debts that could be in the company, again, there's always some things that should be contextualized then depending on the stage. But just to give you some examples. Legal. So all the kind of relationships with stakeholders and also with the IP, if you have the startup as intellectual property asset. So legal means the contracts, maybe with possible partners. If again, the startup is hardware company, maybe you have a contract with a supplier for giving you the input material. Again, this is very important, okay? Because just to understand how things are going specifically in the legal perspective. Tax due diligence, again, if depending on the specific, I would say, legislation, you may have to have a declaration of taxes each year. So again, it's very important that also these kind of documents have been organized very well from the startup perspective. The business one, so this is more about the business plan and whatever, these kind of things. So the list maybe of customers, you may have already customers. Operational one, as I said before, if you have a facility, all the things that are related to production sites and whatever. The environmental one, which is now very relevant for impact investors. And impact investors are those that are focused more on investing in startups that are developing solutions for tackling also environmental challenges. Human resources, all the relations that you have with the employees, if any, okay, contracts and whatever. Just to give you a little bit of contextualization. Now, this is an example. So before moving forward, I would like to present you this example. This is a structure that we use as meta internally for one of our funds. So as you can see, there are different moments of interactions with the potential VC fund. So starting from the third line, there is the application. So the registration form in the website, you need to pass through applying, through sharing specific information in the form. Yeah, then there is a business analyst, which is making eligibility check criteria, understanding if it's eligible for the investment. Then it passes to, let's say, more senior level, understanding if from this first check there is, after the first screening, a quick scan, there is a go or no go. If this, business analyst was saying, yes, it was to take more deep inside the analysis, what's happening is that the fund manager was going through the due diligence. So as you see, until a first quick scan by a junior level business analyst, the fund manager was not involved because there was a screening and this kind of screening was helping to select just only the most promising ones. If it was passing this preliminary assessment, there was the diligence phase by the fund manager, supported also by the specific a team inside the VC fund. It could be other analysts. Then there was the due diligence report that was then combined with the term sheet with the main clauses. But then what was happening is that there was an investment memorandum if everything went well. But what was very important is that if there was a need of an external expertise, there was also a supervisory board, which is deeply involved for specific assistance. So if there was an application with some relevance about IP, then there was a supervisory board, somebody with this expertise giving a tip there. But what was relevant is that if everything goes well, then there was the board of directors that need to notify positively the startup. Only if the board of directors with the resolution saying yes, then there was the investment contract. Okay. Then there was the monitoring, the exit, and the liquidation, and so on. But as you can see, before arriving to the due diligence, there was the preliminary level of analysis. There were different people involved. As you can see, so the due diligence phase then was also adapted to the specific case. If there was more need for IP, if there was more need for financial assistance. So depending, the specific level of the application of the startup, there was, adaptation. So this was just to give you an example how a venture capital fund, early stage venture capital fund can structure their due diligence. So business angels and we can say early stage venture capital funds. So these are financial stakeholders providing equity, risk capital money in the first stages of the company. So the ticket that they can provide are up to $1.5 million, more or less. Okay. Then all the rounds are, provided by other kind of financial stakeholders that are entering in a more mature stage, let's say. Just to, again, give you a briefly outlook of the differences. Business angels, high net worth individuals, people, they're investing their own money. Okay. They can organize themselves in syndication in business angels network. So more business angels providing money, so multiplying their investments for closing the deal. Vice versa, funds, venture capital funds in the early stage are structured that are supported by an asset management company. So the fund is a structure that as a legal entity, which is based on a an asset management company. And this fund is investing other shareholders, other stakeholders' money. Usually behind the asset management company that are investing in early stage startups, there are stakeholders like development banks, like, the European Investment Bank in Europe. There could be the financial pension funds. There could be also banks. So all stakeholders that are putting the money in this asset management company, and then by the creation of the fund, they're investing in startups. So business angels, they're investing because they were maybe already entrepreneurs themselves, because they cover an important position in big companies, and then they would like to give to the new entrepreneurs the right push for entering into the market. Usually they are prone more to give an hands-on approach, meaning not only investing money, but also giving the support for networking activities with the customers, other potential investors, with suppliers and whatever. So they are giving not only money, but also a big support, so hands-on approach. How they're evaluating personal feelings, guts, market trends, their expertise, because maybe they have expertise in a specific field. And as I said, they can arrive up to 1 million in syndication. Usually, depending, on the specific average of business angel of the person, the single business angel can invest, I would say, up to 500,000 if maximum. So 1 million is when they are syndicating. What they are requesting, usually, in Europe, looking at the pitch book report that it was sent out for the last quarter, in pre-seed stage, business angels are acquiring usually 15% of the company in Europe, the startups, okay? So they're asking for an average 15% of the shares of the company. They're asking for a managerial involvement, meaning being part of the board of directors, and having a clear exit route. So another important tip, when you are supporting, advising your startup teams, please work together with them in when they are starting to look around VC or business angels, to think at which could be the exit route. We discussed it before, two main exit route, IPO or acquisition. This is crucial because it shows an alignment of interest in creation of value and the distribution of this value in the future, okay? A suggestion here is when you need to reply to the question from the startups that may have this kind of doubts of how I can benchmark and forecast an exit route from a startup, you need to help them in assessing what did similar startups in the past months, in the past years, similar startups, and how these startups exit. Sometimes we are, benchmarking a startup with other in the past, and how now these startups have exited their investors. So we said a lot of times that in the slides, in the pitch, or in documents, you need to say, okay, we know that in the past there was these two startups that were acquired by Bayer, by Pfizer, by a company. And on average, the valuation of this company was this level. So this shows that you understand that you need a certain moment of your time to generate value and distribute with investors, especially with a business angel. So benefits for having a business angel: this person can be familiar with the technologies, so giving you an expertise also in the technical development, can have an expertise in the business modeling, in giving you network for customers, suppliers, and may give you access to additional investors also. So as you see, it's an important connector, the business angel. Seed and startups funds, again, they are having an approach which is safer, let's say. They would like to the risk of the majority of the investments because, again, they are investing other people money. It's important that funds usually have a specific sweet spot. This means they're investing in a specific country or in a specific sector, in a specific stage. So when you are advising startups in matching with potential investors, first thing is understanding the startup's profile. Once you understand the startup's profile, you need to look for investors investing in that profile. Because if you are chasing the right investors, it's a waste of time. The wrong investor, it's a waste of time. Then what is important of the seed and VC funds is that usually they can invest also they can be investors in other rounds. Francesca said last time, for those that were there, that a good investor is one that can invest also for the next rounds. Why? Again, this was a question related to one of the chat issue raised, that if you spend time with these investors for the due diligence, as we saw, it's a lot of time, and this investor is already part of your shareholders now, and then you are looking for another round, maybe after 6 months, 1 year, then you can ask this investor to be part of the new investment round. And the advantage is that the due diligence process will be shorter. Why? Because these investors know you. It's part of your shareholder base, knows you. So if you take with an external investor, I don't know, as founders, 2 months and a half, maybe it's with 1 month you can have other money. Very powerful. So this is a very good, important point for VC funds. Then they can have bigger tickets, usually on average, okay, rather than business angels. So how they are evaluating the funds team, but again also business angels. Team is important. They are not investing in ideas because there could be tons of ideas, beautiful, but only few group of teams are succeeding. So that's why they're focusing on the team, okay? Market, growth potential that there is behind the business opportunity. Remember that you need to grow, the startups need to grow in a very shortened time frame, so the market behind should be very growing. Clear business model, meaning that you need to understand how to monetize. Startups need to understand how to monetize money from the customer's perspective. Clear exit route. Also, the VC funds would like to see that there is an alignment of interest, saying that at a certain point we would like to sell to Pfizer, we would like to get an IPO, and return on investment, which is again the capital gain. This is something that investors but also business angels are looking for, and also the assessment of the business opportunity and the fact that how fast you can grow is something that can help them to assess which could be the gain from this investment. So these are some questions that investors are asking themselves when going through the specific areas that was in the previous slide. These kind of questions are very important also that you are sharing with your startups, you're supporting. Why? Because you need to support them to properly assess them and to see if there is a match with this expectation. So is the team experienced and well balanced? Is the team fully committed? Can the team execute properly the plan? So these are important questions around the team. Then, is the market enough big? How fast is the company growing in the next 5 years, and how many shares can acquire from this specific market? Which could be the regulatory and macroeconomic impact for this kind of market? Because again, if there's a bigger point about, I don't know, bio company, about regulation, about the clinical trials, for example, then imagine that, this kind of perspective of risk, it's different. Then business model, is this something scalable? It's something that's clear. It's something that you already test with the customers. And then the exit, which kind of exit? How much money the company would need before exit? Because before exiting, maybe you need to reach a certain level. If I'm investing in a pre-seed, maybe you need other money to be put in the company. And this is another important point to understand the dilution. I don't know if Francesca explained this concept, but just to go quickly about this, startups, if they have more investing about risk capital investments, startups are selling a part of the shares. So if in the first round they're selling 30% of the shares to the investors, this means that 80% are owned by the founders, 20% by the startups, by the investors. If startups need another round of investment, what is going to happen is that the existing shareholders, if are not participating in the next round, they can get diluted. This means that founders will not own anymore 80%, but less. This means that the investor in the first round will not hold 20%, but less. And the new investors will have the rest of the company. So this means that investors need to take it into consideration, okay? Also when starting to think about if investing or not. And in case, which could be the price. And which could be the exit time. Depending on the stage, depending on the specific constraint in the 5-6 years, how and if this company can be manageable to create an exit opportunity in 5-6 years. As you can see, all questions that are very important. And if you start to work with your startups during the preparation phase in the incubation program, I think this is very important because they can digest this, can work around this when they are, preparing themselves for the due diligence, and then can increase their chance of getting funded. Management team, as I said, it's crucial. There is this kind of rule of thumb that investors prefer second-class idea, but top team, okay? And this is something, crucial. Remember, in not incorporated startup or startup with just 1 year of incorporation with pre-seed stage, there is nothing inside the company, nothing. And the only thing that why investors are investing is because the team that can be able to transform this startup in a company, high-growth company that can give back money. Okay. So
Lorenzo,
yeah.
maybe I could ask a question, this is Douglas, maybe I could ask a question. It seems like a good opportunity at the moment.
Yeah.
Of a very practical example of an exit, or could you please provide a very practical example of an exit for a startup in the agro sector, Senegal, for example?
Oh, okay. I don't know, again, unfortunately, very well the Senegal market. Again, but I could imagine that, if you are in a agro sector, I don't know in which kind of value chain, which kind of product, but maybe there could be or a big company, big national company, or a multinational company with a specific focus in Senegal or in the African market, which are, selling similar products, or I don't know which kind of things that this startup is developing. So what do you need to look at is, are these kind of big companies prone to buy technologies from startups? Because if this is the case, you should think that, okay, in 4 years that we are working around our startup, then we are arriving in a specific moment where we have customers, we test the technology, the product or whatever, and the bigger company, that could be the national one or a multinational company, are interested to have this technology, this product in their portfolio. So you can knock on their doors and saying, we can, give you this, product or whatever. And then if they are prone to do this, of course, they maybe can have corporate VC fund. So meaning that they have specific funds to be invested by the company for new technologies. And if the case may be, at least in Europe, it works. Okay. I don't know if the IPO could be an option, because I don't know if the stock market in Senegal, how strong it is, especially for companies, if it's active or not. In Europe, especially, maybe not looking at the UK, but other countries, it's not super, let's say, frequent, but maybe also IPO. But in this perspective, I look more about acquisition by bigger companies in the agricultural sector. Could be, again, how then you can assess this, make some desk research, meaning pitch book, there could be D-Room, there could be Crunchbase, this kind of database data set where you can filter the startups by exit. Of course, if you have a license, you have access to the whole data set. If you don't have a license, but a free license, you will have access to just the first 10 rows. But it would be enough for you to take a look if in the specific market in Senegal already other startups in the past, which developed always agricultural innovation, already exited, and how this startup exited. So you can take a look at which was the way that they exited, so IPO or trade acquisition. So put this into consideration to make some desk research, okay? If some, let's say, success stories exist. So I hope that I try to clarify this point. Okay, so again, evaluation, it's, more as we saw before in the process that I shared with you that we did for our fund. It was a little bit complex, but they look also a lot of portfolio synergies. This means that when you're creating a portfolio, the VC fund, they're trying to make synergies about the startups. The startups can help each other in growing, okay? So if already exists a startup similar to yours with the technology, with the specific business model or whatever, then maybe you should realize that it's not the right investors to chase, because maybe these investors are not looking for a sort of similar companies that they already have in the portfolio. Investment up to 3 million usually in this kind of investment stage for seed and pre-seed. What they're asking, always looking at pitch book at European level, also not only business angels but also VC funds in seed stage were asking for the on average 25% of the startups. Okay, then they're asking a seat of the board of director. Different kind of clauses that I will not now go into the detail because otherwise we will take too much time about the term sheet, but they're asking specific clauses and again a clear exit route also for them, which is very relevant to have. Then if I can move down, okay, this is just to explain how it works, the VC fund, but we can briefly go through it. There is the fund, as you can see in the orange box. The orange fund, it's based on a specific asset management company. Okay, and this asset management company is managed by the general partner, the green box. So the general partner is the responsible to manage the fund, to decide which kind of strategy give to that fund. So how much money to invest for each deal, which is the geographical focus, and so on. Then you have in the light orange box the limited partners, the investors. Basically, these are those providing the money for the VC fund. Who are the investors behind, as I said before? Regional development banks, government, sovereign government like European funds, could be also pension funds, and so on. Then these VC funds, can have a different, as I said, strategy. Could be seed, could be more in startup, could be more in expansion financing. Okay, and then the funds are investing then directly into the companies, the startups. So as you can see, this is a structure, and just to let you know in deeply how it works for a VC, the process, and who are the parties behind the VC fund. So now I would like to move to this topic of metrics. So I think probably that those that are trainers today, are coaches in this audience for incubators, that you may work with your startup around the metrics. You already try to support them in properly fixing, assessing, and measuring the metrics. This is an important topic linked to the due diligence. Why? Because in the due diligence phase, there are expectations to be met for investors. And we discussed which are these kind of expectations in both business angels and VC funds. So what you need to properly share with your startup is that prepare a clear dashboard of metrics to be measured and update these metrics and understand if today the level of the metrics they reached, it's enough for the investors. Just always to be linked to the session of Francesca, if you know that risk capital investors, business angels for pre-seed stage are looking for a specific kind of metrics, and then the startups you're supporting, it's not reaching this level, then it's made no sense for pushing for investors or business angels investment, because maybe all the time you will listen, no, it's not interest for me at the moment. So it's very important that you work together with the startups around identifying the right metrics and measuring them. Always, this is the title of the slide, which is linked always to the fact that the execution is crucial, the capability of the team is crucial. So, but how the team is successfully leading the startup. The only way is that they have, the startups, a data-driven approach to succeed, okay? So I think also in the second session, maybe there was the introduction of the lean canvas, the business model canvas. So again, imagine that during the test session was explained the lean canvas approach, and this is linked pretty. So you need to measure that what are you doing, the execution of your plan, it's going in the right direction, okay? Because otherwise, also when presenting to the investors and you are not able to present the right level of metrics, then you are out of this kind of investment financial tool. So why a startup should track metrics since the day zero, since the day one? So collecting, analyzing data helps the team to properly execute, okay? And the more you're reaching results, positive results that are coming out from these metrics, the more you're showing what is defined as traction to the investors. Showing traction to the investors, it's something crucial because it is a sort of de-risking level that you are showing to the investors. In the Bay Area, there is a very nice, let's say, theory. It is the onion theory. So the onion has different level, and as startups, you need to push your team, of startups to follow this theory, because what the investors are doing is trying to understand if, the level of the onions is that, too many or not. Investors would like to have onions with any kind of, level. So with the core, let's say, rather than having a lot of levels which need to be proved. So it's important that you're working with your startups to delay the level of the onions, okay? So just to say, traction around, the market, the customers. If a startups in a pre-seed stage that have no revenues shows that they signed in 3 months 40 letters of interest from potential customers, this is a level of onions away. So the investment from the investor's perspective is less risky. If you have the patent already received, approved by the authority, which means the IP, the asset, it's in the company, this is another level of the onion that it's away. So you need to work with your startups around this. So which are the main areas that are relevant to prove traction? The execution could be the market, could be the IP, the technology, could be the production, could be this. So, and then for each of these areas represent the level of the onions, and you need to show that the level is away because you prove that you're going the right direction, okay? So traction. So founding team, why your teams should focus on metrics? They will be focused on execution, on the real target. They can pivot their findings, their insights, so avoiding all the guts of the feelings. So what is based in the facts, it's more powerful than what is based in our guts. Why? Because we have data. And if the data is telling something which is saying you're not going the right direction, then you can pivot. And in the early stage startup, this is very useful with the lean approach. And then having metrics helps you to have all the team members to go in the same direction. Investors' perspective, why investors would like to see metrics and are eager about this. They would like to understand if you're going the right direction, okay? Traction. They would like to reduce uncertainty, so the onion theory that I was mentioning before. And they would like to evaluate if there is still margin for growing this traction. So if your startup, it's becoming a real high growth company. So 2 perspectives for metrics for the investors and the founders, the teams. But as you see, there is always in the middle the fact that both of these perspectives are for creating value. The creation of value is something common for both the founders and investors. And what you need to do as support organization is to push your funding team in creating the value and showing that this creation of the value will be shared with investors. Okay, and this is crucial. Just to give you a bit debrief around the, KPI and metrics. So when you're working with your startup, there are different levels. Okay, KPI, it's a specific goals for the company. Okay, so it is a key goal that the company wants to reach. The metric, vice versa, is more tactics, is a specific figure that you are measuring that at operational level can help you to reach the KPI. Okay, so they are somehow affecting the metrics, the fulfillment, the achievement of the KPI. So KPI, high level perspective, more used for strategic decision. Metrics, more tactics, are involving specific areas of the companies. Okay, and they can be, let's say, more focused on a specific operations rather than the high level of the KPI. Just to give you an example of this, and when you're working also with the teams of that you are supporting. So if again, just looking always the perspective of having the point that you realize with the startup that they need a specific amount of money, and one of the potential financial shareholder could be risk capital investors, business angels, or VC. And you decide that, okay, let's see which are the expectations of the VC. So maybe they need to have a specific show a growth, in this case of revenues, but could be growth of market demand. But let's think that, okay, revenues could be in the stage of your startup something feasible. The KPI could be, if we would like to be appealing with investors, with these specific VC funds, we need to increase our sales of 20%. So our growth rate in 1 year should be 20%. KPI. A big goal, because the sales, the revenues are affected by different, let's say, leverages. And these leverages are the metrics. Okay, so now I don't have a slide for this, but just to make this sort of let's say exercise. So if you need to support a startup in growing 20% by the end of the year, which could be some metrics that you suggest to track for reaching this KPI? So just to make this sort of open question. So maybe you can write in the chat. So if you need to say to this team, okay, this is the goal that you need to achieve, and which could be some metrics to achieve this 20% of growth at the end of the year. So maybe we can wait just a couple of seconds if there are some volunteers that are writing in the chat. Otherwise, we will go through the disclose of some examples. Okay, there is nobody that would like to take this question, but okay. So there is no slides with the reply, but one of these metrics could be view of the website. Meaning, okay, we are a software company, we need to generate interest from potential customers. Marketing team should be focused on increasing the view of the website. Maybe another metrics could be, let's say, the convert ratio between the visitors and those that are becoming customers. So each 10 visitors, how many buyers, customers are we achieving? So if, for example, now we are having 100 of visitors with one buyer, then 1% that would like to increase of 3% to make this increase of sales. Then other way to increase the sales could be maybe pushing better if we have our sales team. So having an incentivization of, the profit share with the team. So as you see, there are different metrics that if these metrics are fulfilled, then the likelihood of reaching the main KPI, it's higher. So these are just an example, but just to let you understand in that you need to help the startups to understand which are the traction to be proved and how these startups can work to reach this traction. This is an important tip that you can share with them. Good metric, which is a good metric, is a definition that, just for let you understanding how a good metric could be structured, must be understandable. So something that you have a look at and you understand immediately what is this data telling. Because if the data you are communicating it's not clear, it's because maybe the data, the metrics itself is not understandable. Comparative, something that you can compare over the specific time frame. This is very important because that you need to track and have this kind of understanding if the things in a different moment are going better. Okay, a ratio is always better than an absolute figure, because ratio it's more representing the reality, because absolute figures sometimes are not telling or not explaining the truth about how the execution is happening, and then behavior changing. This means that when you look at this metric and the metrics is telling you something, then you understand what you need to do, or potentially what you need to do. So this metrics gives you an immediately changing on the route. Okay, so metrics, this is the question for helping startups in understanding which are the metrics that they need to focus on. The main two things that are affecting the definition of metrics for a startup are two: the type of business model, so the business model itself, and which is the stage of the startups. So combining these two elements, then you will have a specific group of metrics. Just to give you an example, if you are in a biotech company or a software company, then of course the metrics you are focused on are totally different. If you are a software company in pre-seed, or you are a software company in early stage, which already a lot of monthly recurring revenues, then of course the metrics must be different. So as you see, sector, business model, and the stage. So these are some examples of 9 business models, common business models, because as we discussed it before, one of the main leverage for defining metrics is the business model. So depending on the business model here, we will define some example of metrics that startups should focus on. Okay, and knowing this, you know that, okay, if I'm supporting a software as a service company, an advertising company, marketplace, e-commerce, or whatever, there is a specific group of metrics that you need to be focused on, because also investors would like to see the traction of your startup. So these are 9, let's say, business models. There could be more, but just to give you enough examples, or have covered the 90% of potential of the spectrum of business models that you are supporting in your incubators. So this is enterprise business model. So enterprise, I don't know how many of you have startups around this business model, but they are selling on license basis their specific software. And usually these contracts have long and fixed terms, okay? And examples of the company using this kind of, business model, Microsoft, for the licensing of, the Office package. So which are the metrics here that if a startup under this kind of business model should track? Bookings. So the sum of the value of all customer contracts. Again, if you are in a stage that these companies are in revenues mode, then of course you are telling bookings. If you are in a pre-seed show and you need to show the traction, you need to show the LOIs. Okay. Again, in this perspective, the 9 verticals are focused on startups which are generating revenues. Okay. Then total customers. It's important to understand how many unique customers you have today. Why? Because concentration issue. The more you are diversified, the portfolio of your customers has this kind of business model, the better for you in terms also of risk. If one customer is getting away, maybe all the revenues flow, it's over. And then the revenue, meaning that which is the value of the service that you really delivered. Okay, so to understand which is the missing part of the contracts that you need to turn into revenues. So these are common mistakes. So bookings and revenues are different. Why? Because bookings are the total value of the contracts. So if you're signing now a contract for 2 years with a company, so a startup it's selling, I don't know, a contract of 3,000 euro, then maybe the revenue that they are generating for that year, it's not 3,000, but it's 1,500. Why? Because maybe the contracts it's lasting 2 years. So, and it's the value of the service, it's split at 50% each year. So pretty important that these are different. And LOIs and verbal agreement are not, bookings and revenues. So are just a proof if you are in the pre-seed stage that you're doing well. But if you are in a more mature stage, generating revenues as startups, you need to show the revenues. Software as a service. So selling subscription for specific, hosted cloud software, Dropbox, for example. So which are here the metrics that are important? The monthly recurring revenue. So how much revenue are you generating each month recurringly thanks to your license? The annual recurring revenue, which is basically the monthly recurring one multiplied by 12. Then these are representing how good you are in engaging with the market demand, with the customers. Another good metric here is how good you are in sticking with your customers. Why? Because this kind of subscription-based, there could be a high churn rate, meaning customers dropping the service after 1-2 months. So what is important here is that you are measuring how many customers are churning every month. Okay. Again, the bigger the worse for you, because you are losing a lot of customers every month. And then what is important also, the paid customers acquisition cost. Why it's important? Because here you should understand the level of investment in terms of marketing divided by the total customers acquired within a specific time frame. This will help the startups to assess how much it costs to engage new customers. Just to give you an example, this is to understand the margin that the startups may have for each customer. So give an example, if you are following this kind of startups with software as a subscription model, and these startups, it's having, I don't know, €5 of paid customers acquisition cost, and the monthly license, it's worth, I don't know, 15 euro, just guessing. Then the money you invested for acquiring that customers is 5 euro, but you are generating 3 times the value for acquiring that customers, which is a good level. So this is very important, because this helps you also, being a software company, to understand if you can also maybe decrease the paid customers acquisition cost thanks to the, let's say, the word of mouth, which is another important level of growth when you are growing. Think at Facebook or other kind of, or again, Dropbox, maybe at the early stage, they were having paid customers acquisition costs. Then once Dropbox was sponsored by customers saying, why do you not try Dropbox for these kind of things? Then, the customers were generating by the word of mouth, which is the best way for growing. It's important that, just one mistake, that you're not including, the startup must not include in the monthly recurring revenues one-shot revenues. Because, for example, there could be, support, IT support, which you are charging once because there is a need with the customers, but then it is not a monthly recurring revenue. It's a one-shot. So the monthly recurring revenues are those coming from the license. Subscription, so company selling a product or service on recurring basis, Netflix, if you're thinking about a service that it's under subscription. Here you should look at the same kind of metrics for the software as a service. How many monthly revenues are you generating? If these monthly recurring revenues are growing on a monthly basis, how many customers are dropping each month, and how much you are spending for engaging with the customers. Then transactional. These kind of business models are monetizing on the value of the transaction happening in the platform. So basically, think at PayPal, Stripe, this kind of platform where people are making payments, and PayPal is generating money through each transaction based on the amount of the transaction, okay? So which kind of metrics are important here? The total amount that it's transacted in the platform, how much money you are taking as, transaction fee, user retention. Again, here it's the same of the churn before, it's the opposite, meaning how many customers from the previous month are still using my service today. So the more close to 100%, the better. And again, always the paid customers acquisition cost, which is, I would say, relevant because in this kind of software startup, it's very important that, you need to have a license fee, a monthly fee, which is, I would say, pretty higher than the marketing expenses. So it's important to not avoid when startups are making this kind of dashboard of metrics to avoid confusion between gross transaction volume and revenues, because the revenues are those that are part of the fee, transactional fee, while the gross transaction volume are those of the transactions happening in the platform. And what is important is that try to calculate on monthly basis the same cohort of customers. So meaning that if you have new customers in a specific month, you need to understand this group of customers, how the retention rate is evolving, because you need to understand in each cohort if the customers are increasing the retention rate or not. Just to give you always an example, if you're working with this kind of startups, it's important that you push them to work around this, meaning that if you are in a growth, let's say, curve, the customers involved in the first month of the operation of the company maybe have a retention rate of 60%. What investors are expecting, and you should expect as founders, that after 6 months, so on month 7, the customers on board on month 7 should have then in the months after a retention rate maybe doubled. Why? Because this shows that you are delivering values to your customers. And again, this is a proof of the traction. Marketplace, think at eBay, so being an intermediary in the transaction and taking a fee of this transaction. It's more or less the same of the transactional. You need to take a look at the total transactions happening in the platform, the net revenue, also the compound monthly growth rate, so which is the monthly growth basis. Again, if I'm saying if you're looking for risk capital investors and you are in this kind of business model, selling a software or a marketplace, and you need to show to investors that you are a high growth company, you can't say that your monthly growth is 3%, 4%. Again, it's not bad, meaning that you will be profitable, but investors are looking for those that are high scaling, high growing. So that's why maybe, again, here as monthly growth rate, you should aim at higher level. Again, there are tons of database where you can take a look at the standard growth monthly rate for the specific industry. Okay, so just to give an idea of the benchmark, so to see if you are in line or you are overperforming. Then user retention and paid up customer acquisition cost again are the same from the transactional. E-commerce, in this case, you are selling physical goods online. So e-commerce company are manufacturing and storing the specific goods. So in this perspective, you are turning as a business model, a startup, into a more hardware company, because you are producing a product somehow and you're selling through the website. It's important, the monthly revenue, of course, the monthly growth rate, but what is important is the gross margin. In a hardware company, the gross margin is, looking at the total revenue less the cost of goods and of sales and goods sold. This means just looking at the cost you are bearing a startup for producing that specific good and product. Why it is important in this case, the gross margin? Because first of all, you can benchmark with the sector. So if you're a startup producing sunglasses and your gross margin is 60%, and on average in the sector 80%, then maybe you should ask yourself what is wrong. It's important because you are the higher, the better, because then you have more money that you can spend for advertising and for growing, for boosting your growth. Otherwise, if you are having low margin, then the money that you have left for pushing in the market, marketing and whatever, it's not a big budget, okay? Then advertising, again, Facebook, Google. So basically it's a platform where it's free for one side and the other side it's paying. And which kind of metrics you should take into consideration when working with this kind of startup business model? The total daily active users, it's important because the more the people it's engaged as for Facebook with a platform, the better, because you can attract more advertisers. Monthly active users, again, this is very important because you need to understand, how many people are active in the platform, because you may have a lot of, daily users, but you need to see also at the monthly because maybe one day could be an exception. So in the long term, how many are active? And then the percentage logged in, which again shows, how many people exactly and for how long time that they were engaged with the platform, which is always important, because for this kind of platform, the more the users, the free users are engaged with the platforms, the better, because they can attract more advertisers, growing and whatever. So as you see, shifting in the different business models, in the different verticals, then the metrics are different. So you don't need to always focus on revenues, on these kind of things. Again, this will depend on the stage, but depending on the specificities of the business model. And this is an idea of how the metrics dashboards could be set up by startups, okay? And you as a support organization should work alongside with the startups towards these metrics. And then there is the hardware. Basically, you are producing and selling a products, then it's more or less the same as the e-commerce, where you have monthly revenue, the growth rate, the gross margin, and the customer's acquisition cost. Questions, doubts when we went through these 9 business models that again represent 90% maybe of the startups you are work with in your daily routine. So I don't know if there are questions, maybe not, because
this is Douglas. No questions at the moment, but
okay.
If I can remind people to type their questions in,
okay.
I'll give them to Lorenzo.
Okay, so now before moving, let's say to the interactive part, I would like to maybe briefly present the tool that we are going to use in the interactive part, then having a break, and then after the break, we are going deeply, I would say, in reading the tool field by the business case and asking you, let's say, some questions for making the session more interactive. So before going again to the specific break, okay, the BOSAT. So given that also most of the people in the audience are part of organizations that are supporting startups, incubators, universities, also NGOs, one tip that also insights that we can share from our experience that when you are having on board a cohort of startups, the first thing that we are doing usually is to assessing where they are. And we developed a tool, a self-assessment tool that we call BOSAT, for assessing the investment readiness of the startup or the research team. Because this kind of tool can be used both by an established early stage startup or wannabe entrepreneurs, so research team. So this tool, it's very, very useful because basically you can share with your startups, research teams, ask them to fill this, send you back filled by them, and then comment together. So what we're doing in the interactive session, it's looking at one BOSAT field and comment together. But it's very, very powerful because it helps you in a nutshell to understand where they are. So which are the main goal of this self-assessment tool that we developed? Understanding the maturity of a business project, the potential, the business potential, and the third point is very crucial, weaknesses and strengths linked to the exploitation of the results of the projects or the solution or the product of the startup. It's very helpful because in just reading these documents, you can shorten your process of support to understand where you should fix the main issues within the team. There are 6 main dimensions that we would like we targeted, and because we thought always looking at we discussed it before, the onion theory, at which could be the main areas of let's say importance that each wanna be entrepreneurs team or startup need to work on. The first one is the technology, then the team, market, unique value proposition, intellectual property, and financials. So, technology. Again, disruptive startup have for sure a technology behind. It's important that it's clear which is the technology, and there are 6 questions around the technology that helps to understand if the technology is unique, which is the maturity, and which is the position of this technology. Team. We discussed it quite a lot that early stage startups are stressed by business angels and VC around the team. Team is crucial. In fact, if you compare the number of questions that were in the technology that are just 6, in the team area there are 15 questions, the double, more than the double. So why? Because it's important to assess properly the team. So how the team is managed, which is the expertise of the team, the roles defined, the skills, the expertise. It's always crucial to assess this properly. Then market, the potential of the business opportunity behind your solution, your technology. 11 questions to understand market analysis, market planning, the market launch of the technology, and to understand if, the startup or the wannabe entrepreneurs team work around these aspects. Then the unique value proposition, just 4 questions, but I would say very relevant because this helps you as a coach, you as a supporter, to properly understand if the startup is working on the right direction to reach the product, the problem solution fit, which is crucial at the initial stage because each startup needs to pass through this customer discovery process that it's based on problem solution fit, which means that startups need to work on a solution which solves far away better than the alternative solutions, the problems that they are aiming to solve. So showing a strong and assessing properly the value propositions helps you to see if the startups is in the right position towards this point. Intellectual property. So if you think carefully about the fact that how you need or should to cover your main assets, that could be the technology. So understanding where you are in terms of the process, and if you have a clear strategy around as a startup, then financials. So understanding the amount of money you need, where you can raise money, how much money you need is crucial. Because if you are an early stage, high growth potential startups, you need to work around these points. So there are 11 questions focused on this to understand properly, the expertise in going and raising funds, in understanding how to leverage the scalability of, the financials and whatever. So 6 dimensions, which are helping you as evaluator to understand which are the main weaknesses to work around for the specific team, okay? So 59 questions, as you see, the main are under the team, because it's also the division of these questions are representing where the investors are putting the attention more for evaluating the startups. Then in each of this, depending on the reply selected in each question, because the replies are text replies, depending on the one selected, there will be a linked score between 1 to 5. Okay, so there could be a maximum score for the specific, and a maximum average score for each area of 5. So meaning that if for a specific area the startups has a 5 score, this means that under that area the startup sits well positioned. Okay, vice versa, if the average score is 1, maybe there is a big weakness. This is the output. This means that in the Excel file, after there is the filing of each specific questions, there will be this spider graph where you will have in a quick shot where there are the main weaknesses. In this example, in fact, there are weaknesses around the team, technology, and let's say IP also. So as you see from the spider graph. So in the interactive session, that maybe we can have, I would say, after another short break, we can have the review together of the business case. I will present you the business case. I will share with you the Excel file with the boss field by the team, and then for each section we are having a slide of question to understand together which are the main weaknesses or the main you define in the expectations, red flags, yellow flags for investors. Okay, and you as evaluator need to take with the startup to improve the investment readiness. So I think that just to come back, we can have now a break. Again, of 15 minutes. Maybe we can reconvene at at 5 p.m. your time. So so we come back and close with interactive section. So in the meanwhile, if you have questions, doubts, please write in the chat.
Thank you, Lorenzo. See everyone in about 15 minutes time. Hello, Lorenzo. Again, this is Douglas. There are there's 2 questions which were done during the break. I don't know if you can see those, or you would like me to read them to you. Your microphone is off.
Yeah, well, look at them. Yeah. Around 80 startups in Europe. You also invest in startups from Africa? No, we never invest in startups from Africa. The size of investment, well, I think it was, let's say that on average, it was $1 million. So that was more in a seed stage, not a pre-seed. So it was more seed stage. So it was $1 million of ticket, and take into considerations that what we did was more related to a sort of co-investment scheme, meaning that our fund, which was 20 million as a regional focus, and we need to find other 20 million to match this finance for leveraging the resources. Okay, so imagine that in each deal, our ticket as investors was 1 million, but we need to find another one from other investors to leverage that ticket. So if you ask, the ticket for the startup was 2 million, but our ticket was 1 million, okay? Because we have this kind of scheme that was a co-investment fund, and being a co-investment fund, we always needed to find another investors to match. Then can you share the 59 questions? Yeah, I think that after the session, I would share with the BIC Africa team the Excel file that I will now share with you, filled by the business case, but I will share with BIC Africa that then they will share with you for sure by email. So you will have this also for your use internally for when you are maybe supporting startups. Okay, so I think that now maybe we can start again with the last session, let's say, the interactive one. So I presented you the BOSAT. Now what I would like to do is present the business case. Okay, so now let's put the hat of the experts. Let's put the hat of the coaches that are working in an incubator, in an accelerator, in technology transfer office in university, whatever. Then, which is the business case? Well, this is a proof of concept, a research project which has main goal to develop baby wet wipes, eco-friendly and with a sustainable concept. Okay, so which are the main points? Technology area is wet wipes manufacture, and the target market, the sectors they're focused, in which they're focused to exploit this new concept of wet wipes for babies, are the baby wet wipes and baby consumables. Okay, so this is just to give the context. The technology readiness level of this technology is 3. So they were just experimental proof of concept, and basically they need to increase the TRL before getting into the market. So this is always a sort of document that you received, let's say, with an application form, because this is something that we were doing also when we were support startups, especially for different initiatives. We were asking to fill an application form. Then we have a sort of quick, let's say, information, quick scan about the startup. And then we send the BOSAT. So now what we are reading is a sort of filling the information on this application form. Beneficiaries problems. So this group of research group was aiming to solve the problem that what is commercially available as baby wipes was these wipes were based on chemicals, which were compromising the safety for daily activities. So the babies were having issues like skin irritation, red rashes, and whatever. Market size, they said that this market, the target market of baby wipes, was raising, and the estimation is that, and this is very interesting how they calculate this estimation, on average, for 1 year baby, the tissue used were between 7,300, 9,125. So as you see, there was a big market opportunity behind. So, and the way they presented this kind of, market segment, the description of the market opportunity was not just saying, this is a report, and this report they're saying that each year this market is growing 10%. They showed to him, that on yearly basis, on average, there is this amount of wipes to be used for a baby. And if you multiply this worldwide for each baby, each year, there are billions of baby wipes that are sold. So it's a good way to give perspective. So the solution, they were providing the wet tissues based on different compositions, only natural ingredients, and also different packaging. So mean that they were packaging this kind of solution, the wipes, in recycled materials. Okay. The unique value proposition, quality, skin-friendly, that can have anti-inflammatory, antibacterial, and hypoallergenic. Price, they were able to reduce the price because, reducing family cost, it's a good way. And reducing waste and protect the environment, because these tissues were designed for based on material that were eco-friendly and recycled material. So the team, there were 4 people. The leader, that was an associate professor and the faculty of chemistry, and this person was very focused, on running different national projects, and was as a scientific background. There was team member number 1, again, a researcher at the Faculty of Chemistry, and was focused again on the technology side. Then there was a PhD student, last but not least, an engineer, where was having an expertise in developing new products, and he is working also with small and medium companies for defining new business models. So this kind of person was showing, let's say, the more relevant impact around the business. So roadmap, what they would like to do once they were looking for the support. So they want to make these public procurements of raw materials, because they were part of an university, so they would like to buy raw materials to test. So they would like to test in depth and select the best quality components for their new tissue. Then start to manufacture first, let's say, concepts of baby wipes, quality control to see if really everything was going according to what they expected. Then going and asking to the market with focus group to understand if there could be an interest for the wipes. Setting up a website, then develop an MVP, and to start raise interest from the market, and then also start to assess with an IPR, with the attorney, an IPR strategy, because they were developing a technology which could be patented. So this is a little bit, a process that we suggest for you to follow also as organization, as incubator, as accelerator, as technology transfer office. There are a lot of business ideas in universities, in incubators, or whatever. Then what is important that you have a process to collect this business idea through form for presentation. Then once you have this form and you understand a little bit the idea, then you ask the team to provide and fill the BOSAT. Then expert we review these BOSAT 10 gaps will be identified. Then last but not least, supporting the team to say, okay, these are the weaknesses, you should work around this and that. In order for having, I would say, a good starting point for accelerating the investment readiness process. Some suggestions: ask only for relevant information. So especially in the quick scan, when you need to ask for the main information, so just avoid a long, technical explanation about the technology. Use self-assessment tool for better understand and evaluate the idea of the wannabe entrepreneurs. Check the coherence. This is very important between the business idea presentation and result of the self-assessment tool. A lot of time there are misunderstanding behind the questions on the form or in the BOSAT. So that's why it's always good for you to make this exercise to have a clear view of the situation. And last but not least, when you are discussing potential roadmap activities to do with the team, it's important that these actions are linked to the gaps that you identified in the analysis of the BOSAT. Okay, so just to make this process smoothly and clear. Do you have any questions about this business case? Anything that was not clear? In case we can start.
There's
with...
no questions in the chat.
Okay.
So please go ahead.
Yeah. So what we can do now, it's analyzing together the BOSAT. Okay. So I will share with you the Excel file. Okay. And then what I will do is maybe analyzing each section. At the end of each section, I will share again back the slide, because I would like to ask in the chat, in the slide, a specific question to you about the section, okay? So I will now interrupt, the presentation, and I will retrieve back the BOSAT. Give me a second, we retrieve the BOSAT for this. Okay. So starting from so I hope that you can see the Excel now. Please give me, okay, nice. Now, as you see, this is the BOSAT. So I will share, I will share with the BIC Africa team, so then you will have in your mailbox. There is all the questions. Then
Lorenzo, this is Douglas. If it could be made slightly bigger, it might be.
Wait a second. I don't know why. Now it's okay. Can you see it better now?
Yes, that's better now. Yes, I think so. Yes. So
this the questions that you can scroll down and see all the questions. The output graph, as you can see, based on the question said. So just to quickly go through each section. So baby wipes, these teams was keen to introduce baby wipes in the market. So this is how they reply to the technology questions. Okay. So is this business opportunity developing a unique technology? And what they said is that the technology shows an improvement in relation to existing technology. So they're saying it's not a disruptive technology. Okay. Then is the business opportunity technically superior to what is actual now in the market? And there are no known substitute technologies. So it seems that the team does not know that there are now in the market solutions that can substitute the technology they're developing. To what extent has the technology been tested and validated? They said experimental tests in the lab, 3 LT4. Then, are infringing copycat products easy to produce? They said it's easy to copy and reproduce by any similar R&D center. Okay. Then, do you know how to translate this business opportunity into a usable market solution? They said we have developed a strategy for addressing the solution and received feedback already from early adopters. So it seems that they're already working alongside with the early adopters. Then, have you performed a risk analysis related to technology of the business opportunity? Yeah, they said yes. We identify risks and weaknesses. These are the 6 questions that basically are composing the technology, and how these teams that would like to take this technology of baby wipes, they would like to bring it to the market. So based on this first check on the questions, replies from the team, I will come back to the PowerPoint and ask you a specific question. So just to put the head now of a coach, of an expert, I would like to ask you, give me a sec. Okay, I would like to ask you, which is a critical point in the technology? So based on the replies that we collected from the BOSAT, in your opinion, if you look at these replies and you need to support this team around the investment readiness process, which could be a potential critical point? And I will put in the chat maybe slido.com. So for those that maybe not have the link, so please, you can tip whatever you want that in your perspective could be a critical point around the technology. So please, I don't know if with the bar somebody it's started to write. So please, in case, go to Slido and try, to enter in the pool for, making okay. So I see that 2 participants are typing. So again, in your perspective, just to understand, if you got, this BOSAT, the tool. Okay, you don't need to write, a big thing. So maybe we can wait for these participants in typing and then we can comment together. Okay, it's covering that the technology can copy easily, right? Then we have another person that it's okay. Well, I think that, out of, let's say, these 3 replies, you got the point that, yeah, looking at perspective of investors, this fact that they said, okay, we are not pushing a disruptive technology. So it's just, an improvement of existing technology. And our technology, it's something that somebody with our expertise can easily replicate. This could represent a red flag for investors. Why? Because if you are not able to create a strong, let's say, barrier around the technology, I think it could be a risk, okay, around. So that's why the first 2 points here that are in these replies that I see now are coming out, others, the fact that it's easy to be reproduced, it's a red flag, could be a red flag. And you as supporter, you need to address this. You need to support them to address this point. How to work in the technology perspective for making this technology something not easily copyable. Maybe you can support them with an attorney, with an IPR attorney. Maybe in an incubator organization, you have an attorney that can help them to understand properly how this formulation of baby wipes can be embedded in a patent. So this is very important as point, okay? Then technology is scalable. Well, this is another good point. But this is something that, must be clarified, because from the BOSAT was not super clear. There is not maybe a specific point around. But yeah, this is something important, because when especially the goal of production, of making the facility for producing the baby wipes could be very important to understand if, you know, the wipes can be easily scalable. Also, not knowing well about the existing technology for similar products. Well, this is something, yeah, it's not a red flag, but could be a yellow flag because, again, it's always important to know very well alternative solutions. Who are the other solutions that can be used by the customers for solving the problems? And as you said in this replying, this could be not a red flag, but something like a yellow flag, and you need to work on. And maybe you can support them in helping in making desk research on alternative solutions, similar alternative solutions around technology or whatever. If there are maybe other research teams working around better technology. So I think this is very important. So we found one red flag, similar can be copied easily, and then not knowing well about the existing technology, similar technologies. And this is important because in a quick scan, you addressed immediately 2 potential issues that you need to work on with a startup. Now, just let me go back for this. Okay, so I need to now share again the screen. Okay, so now we have the team. I hope that you can see again the Excel. Okay. Team. Okay, we have the team here. So go to the team. Do you have a team? Yes, there is a formalized team. Do you have a team building and a team development plan? They said the team is complete, the roles and competencies plan established. So it seems that they value their teams as complete. What percentage of time do the members foresee to dedicate to the business opportunity? They say all team members work less than 50% on the business opportunity, but we envisage increasing our time spent. Is there a clear structure in the team with separation of roles? Yes, we have a clear structure in place and all key roles are filled in. Have the leadership skills of the person in charge of the team been proved? Yes, by the team members. How is the information communicated between the team members? Regular meetings and tools on a regular basis. Does the team provide internally all the tech skills needed? Yes, but they also rely on external collaborators. Has the team previous experience in commercializing research results? They say no. Do you have people dedicated to marketing? They say yes, with more than 5 years of experience. Do you have experience in raising funds within the team? Yes, there is one, at least, team member who raised public money. Is the core team willing to self-finance? Yes, we are discussing it. Is the team committed to commercializing the business opportunity? Yes, at least one of us is committed. In order to commercialize, you are expected to be flexible. Are team's members willing to be relocated? They say no. Are team members sufficiently aware of all risks to team performance? Official procedure exists. Is the team open to go through a mentorship program? They said yes, the team is willing to be coached for a program. So in a nutshell, these are the 15 questions and how the team replied to the specific 15 questions. Now, coming back, I would like to share with you the screen. So I hope that you see again the screen. Then, same exercise as before. Which is the critical point in the team that you realize from this quick scan of 15 questions? So let's start to write in the chat. You can use the same Slido full as before. I see people is start to type. Team flexibility. Well, this could be a problem. Potential problem, just starting from the first reply, team flexibility could be a problem, because if you are especially looking for money coming from investors that are in other countries, and they are investing in foreign countries, but they're asking for flexibility to open branches, maybe, then if there is nobody from the team they have the willingness to go abroad and maybe support the open of a new branch, this could be a problem. But this is something, very rare, because usually the first round of investments you're doing with local investors, okay? But, it's not a yellow, it's something that between green and yellow. Amount of time spent in the business opportunity, less than 50%, not fully committed to the project. I think these three are representing the main, let's say, red flags. Meaning red flags because they are investing less than 50% of the time. So meaning that this is something like an hobby from an investor's perspective. So why investors need to believe and invest their own money in something that you are not believing in? Because spending less than 50% of your time, it's like, more a passion or whatever. But in the budget, it was linked to the reply. They envisage to commit more time in the future. It's tricky, this reply. You need to clarify with the team. And especially, my suggestion here is that there must be always somebody that it's working 100%. Because if all the team is working just less than 50%, it's more hobby. It's a project. It's not something that they are believing as a business opportunity. So you must clarify this in case with the team. And this is a completely red flag. Then fundraising capability. Well, they have somebody experienced, but with only national grants. Of course, if they would like to go over for private money, this is a yellow flag, because maybe you need to train them on how to deal with risk capital investors with private money, because they do not have expertise. Another way, the commercialization, right? So there was nobody inside the team that have experience in commercializing before. So they are more a group of scientists. This is a big problem, a potential red flag. Why? Because they also said, I don't know if this must be clarified, if you receive this kind of question replies. In the budget, they said, we have all the team is complete, all the expertise. But then when they're asking for, do you have somebody experiencing commercialization? No. So there is an incoherence between these two replies. So it's crucial to clarify this, because if they are not experienced in commercializing, then they need to find somebody. So red flag also here. So incoherence, the team is not complete, it seems. No experience in commercialization, and people not committed. There are all the ingredients for a big red flag here about the team. So you need to work around this group of scientists to help them, maybe in looking for other people that can enter in the team for experience in commercialization. It's crucial for help them for being appealing for risk capital investors. Of course, if they're keen to move forward with public grants, maybe they can survive with this team. But if they would like to move with risk capital investors, you need to support them in doing something. So enlarging the team, being more committed, and experiencing commercialization. Always, if you have doubts, questions on the meanwhile in the chat, please always write down. I would like now to... Okay. I would like now to come back to the always to the BOSET. Give me a sec. I will retrieve the BOSET site. Okay. So giving back now to the market analysis. Always struggle with the sharing button. Okay. Excel. Okay. So I hope that you can see again the questionnaire here. So now market. So is the business opportunity addressing identified and validated customer needs? Yes. I have identified a number of needs that we could satisfy. Has the market need been validated and how it was done? Yes, an external consultant validated the need. Have you performed a market analysis? Yes, with the support of technology transfer office. How regulated is the target market? The regulations are high but well defined, or there is a low risk of a refusal. Have you searched for other existing solutions that respond to the same customer need? Yes. Are competitive for substitutes products active in the market? The BO will provide an exclusive solution to the market. When assessing a potential customers, were you able to identify early adopters? Yes. Identified adopters and have contacted them. Have you developed a marketing plan? Yes. I'm preparing it now with the help of an expert. Has there been any commercial interest in your business opportunity? No. Potential customers were only identified. What knowledge do you have of the application potential of your technology? I validated the application potential with external consultant. Do you have a clear view of the process and the time needed to achieve a market launch? No, I have not discussed it yet. So these are the 11 questions of the market. As always, now I will come back to the PowerPoint asking to you the opinion, which are your opinions about the market opportunity. So the main needs, gaps that these teams are facing, or the things that for you could be something that they need to work on and you should them support around. Where people start to type. So always the same slide as before. So we identified, let's say, 2 potential red flags. Okay, so other existing solutions were not searched well enough. Yeah, because I imagine that you must not be a super expert in this market to understand that baby web wipes are produced by tons, or at least a lot of different producers. So saying that you are producing the only solutions for the market needs, it's wrong. So, and as you said, the desk research must be better done, or you need to support them with this for a market research around. Presence of similar solution in the market. It's linked to this point. This is a big red flag, because if as investors I'm reading this opportunity and I see that this startup is thinking that they are the only one in the market providing baby wipes, it's crazy. Research was done externally. Partially, this could be not, let's say, red flag, I would say. It's it could be something that, especially at the initial level, let's say this early stage, we always suggest that founders are doing things. Then maybe they can be supported to validate what they do. So externalizing from the scratch something, it's not a red flag, but I would say it's something I would not suggest to the startup. So this is a comment that I agree on. Huge reliance on external consultants is true. Requirement of products and availability. Well, the requirements, I think that they said that the regulation is not so high, to the level of acceptance, the risk of acceptance is low. But as you stress in this comment, I would suggest you to clarify with the team, because certification, it's always hard when especially delaying the launch to the market. The availability, I would say that I don't know if its availability is linked to the market launch, because this was another one. The market launch could be yellow flag because they do not have idea still when this could be available in the market. And I think it's crucial, especially when you're talking with investors, to have any idea about this. Because remember, you need to present an exit route. An exit route is based on when you can achieve a specific traction, and to achieve a specific traction, you need to start to sell. And if you don't have any idea on when you need to sell or you can sell, it's a problem, okay? Market cap and competitor analysis, yeah, I think this is something, you need to support them in doing, depending on the replies that, it's have been received. Another point to stress is that what is strange is that they said, because always looking at the coherence between the form, the application form, and the BOSAT. The application form, they said, the roadmap they would like to take in the next months, one of the main area was interact with potential early adopters. And in the reply, they said that they already interacted with early adopters. So there is a big incoherence. So which is the truth, you need to understand. Because one thing is that you need still to clarify and to test with early adopters. And one thing is that you need to do it. So the stage is completely different. And so it's very important for you as a coach to properly assess. Now, coming back to our BOSAT for the unique value proposition space. So unique value proposition, has the unique value proposition been validated? Yes, internally by team members. Can you measure the added value of your business opportunity? Yes, I can in a qualitative and quantitative way. Can you communicate the benefits of your business opportunity in a short message? Easy to understand? Yes, I can without adding technical details, and I have messages prepared for each target groups. Can you position the added value of your business opportunity in the value chain? Yes, but not all relevant actors are identified. So now I would like to always come back to the PowerPoint and ask you your perspective around the value proposition. So again, looking at this, statement, this replies about the value proposition of this potential technology product, which could be some points that you would like to address with the team, with the research team. Well, not relevant actors were identified. Well, this is something, but depending on the stage, of course, I think this is, something that could be or not. Of course, I think that understanding what position the technology or the product is crucial. So especially if we are going to investors, you need to present the business case. So you cannot present, let's say, all the specific, we can define target groups. Yes, yeah. One thing is that we would like to sell directly to the families, the baby wives. One thing is that we would like to take these results to the baby wipes producers. So basically, you are selling you are licensing the composition of the chemicals to the other, companies. So it's true that could be something, let's say, to be discussed. It's not a red flag, but it's a yellow flag, because again, investors would like to see a business case that it's clear, and maybe not relevant actors being a defined value chain could be a critical point. How the product is unique indeed. I think that, the thing that can worry here is that they are not interacting already with the adopters, so they just validate internally. So validate internally means just technically speaking. So they did not, share these values with the early adopters, and this is something that in the onion theory, it's let's say it's not performing well, because it's not giving the risking position for investors. So having the unique value proposition test with early adopters is always better. So that you need always to push your startups to be as soon as possible in interaction with early adopters. Yeah, so this internal validation is external validation. It's the common, yeah. Then qualitative and qualitative. Well, I think that in the bottom it was saying quantitative and quantitatively, so meaning that they have also quantitative evaluation. So I think that it's fine if you have both a quantification of the unique value proposition, so that can be easily stated in, we are 30% faster, we are 22 times cheaper than the actual solution. So, but as I said, work around internal versus external validation, and maybe the value chain that could be a yellow flag, because it's important to present a concrete business case to investors. Then always going back to the BOSAT. Okay, now we have the IP and then the financials. So IP, let me sharing you. So sharing, okay, the BOSAT, here we are. Intellectual property. Is the owner of the IP relating to the business opportunity identified? Yes, there are multiple owners, and this is specified in an ownership agreement. Has the confidentiality of the results been maintained? There has been no disclosure at all. Does the business opportunity include the institution sold results only? Yes, and there is no NDA from a third party involved. Are the experiments observations leading to the BO described in a laboratory notebook, or observation are written in a professional notebook that is dated and signed by a supervisory? As a strategy for protection has been defined for major aspects, with a consideration of a first and future target markets. Have you considered the life cycle of your BO for your IP rights strategy? Experts consider that the life cycle of the BO is in a good adequacy with the IP rights. Which IP rights have you considered to protect your BO? They did not reply to this. Has a prior art research been performed? I did with the help of the team member colleagues. Are products or infringing nature easy to identify? It's difficult to identify infringing copycat products. Not applicable, the patent status of your BO. So it's not clear where they are. Have you performed a risk analysis related to the IP rights? Yes, identified and ranked risks. The last is, does the use of the technology depend on license agreement with the others? The use of technology is dependent on license agreements, but not with competitors. Now,
Lorenzo, just
yeah.
one, before we move to the Slido, there was a question which you might want to take now or later.
Yeah.
What were the red flags then on VP, if any?
The VP meaning value proposition?
I believe so, yes.
Well, I would say more than red flags, it was something yellow, meaning that you should support startups around it. That said, we only validated internally the value proposition. So if you validate internally, meaning that technically speaking, it's a partial vision of the value proposition, because the value proposition must be tested with the early adopters. And if you go to investors and say, okay, yeah, we can be 2 times faster than what is in the market, but then this kind of value proposition, it's not fitting what the real customers are needing, then, it's nice, but it's not something that's relevant. So that's why you need to test with early adopters. So this is yellow flag. Another point was the value chain. So where they do not discuss properly to which kind of stakeholders they would like to position in the value chain of the sector. So, and this is crucial because depending on where you're putting yourself as a company, in this case, baby wipes, if you are selling the baby wipes, you need to structure it in a way. If you are licensing or if you're selling the composition of the chemicals to the baby wipes producers, it's another story. So not red flags, yellow flags that you need to support your startups in. Then I hope that you can see the screen. Now, all the comments that you have for the intellectual property. So always using the same Slido. So which could be the critical points in the actual intellectual property. Potential red, yellow flags from an investor's perspective. Oh, sorry. Status of PO. You mean the status of the patent, maybe? Yeah. Well, this is more something you need to maybe to clarify with the team, because they did not. They say they did not reply maybe in that question, and you know, it was something crucial to understand where they are, if the patent is pending or not, or you know, other things that come up to your mind. Looking at or remembering the 12 questions that we discussed before. The type of IP, yeah. Well, this is something more to be discussed, of course, because it was not clear where they are. So maybe, but they said that they make the sort of desk research already, so with an external expert. So maybe this is something that you know you can clarify where they are and what they discovered. Legal protection, yeah. Again, this is something that must be clarified because they did not reply to that question where you are. But for us, there are two main points here. The first is about, maybe another person is typing. Yeah, copycat. This could be one, meaning it's easy and fungible. So working alongside with a attorney to understand how to create barriers. Second, another point is the multi-owners. There are different owners for this patent or IP. This means that if you need to license, if you need to agree everybody to license this to the spin-off to the startup, because maybe the research team is not incorporated a startup, it's a crucial point. Because imagine that you know, there are one that is not agreeing to move on, then everything is stopped. So it's crucial that when there are multiple owners, you clearly present to the investors that you know, all people, there are specific, you know, framework, there are specific ownership contract, and everybody's agreeing on that. And then once you are licensing this to the spin-off to the startup, there must be an exclusive license, meaning that the owners cannot license to other companies the chemical, for example, composition in this case. Another point is about the fact that they are relying, in the last question, on license agreements. And this is linked to the first point. So if you need to have license agreements for use technology, and this is something strange because it seems that they are, the research team, it's the owner of the technology, why they are needing to license also other intellectual property from outside. So this must be clarified, because if you need also to use other intellectual properties to, let's say, go on with the technology you're developing, then this could be a potential bottleneck for investors. When they're going to the due diligence, they may raise this point, okay? So you need to clarify also this point with the startups. Now we can go through briefly before closing, because I think, yeah, it's 10 minutes. The like that to share with the PowerPoint.
There is also one more question, Lorenzo. Maybe I can.
Yeah, if you can take it, briefly.
In executing BOSAT, are we to assume that participants have know-how about IP? Potentially, that's why they might have skipped some questions in this case.
Well, depending on the background of the team, this team that we analyzed was based on people from research, so they must know this. Of course, maybe they're not coming from people with a background with a research that they know the IP, how it works. It can, maybe not be clear, but in all the questions, I think there is a no reply, meaning that I don't know. It's like a way to express that I don't know this kind of topic. And of course, this kind of reply is linked to a low score. But usually in all the questions that how the BOSAT is structured, there is always a reply, which is showing that you did not something and you are not knowing well the topic. Okay, so that's why the BOSAT that we addressed it is something that is very useful, so to assess these kind of things. Now, moving to the financials, I would like, let me share with you this. Okay, sharing the screen, then so we can have, okay, sharing the screen where you are. BOSAT, financials. So I think that now you see the screen. Okay, so in the financials, let me move down, but now it's freezing the screen. I can do nothing at the moment. Okay, so going to the financials. Sorry, just to scroll down because, okay. Have you ever attempted to raise funds, debt and equity to develop your project? Yes, to prove the concept. Have you already contacted potential investors? Yes, at national level. What access to funding do you have available at the local national level? Access to funding for proof of concept. What access to funding do you have for the scaling up phase? Access to institutional governmental funds. If you obtain funds, is there a clear action plan on how to use them? No. I'm working in the preparation of the business plan. Do you know the exact amount of money needed to make steps towards commercialization? Yes, defined with external experts. To what extent have the financial needs been evaluated? Development costs have been evaluated. How developed is your business opportunity in terms of revenue generation? We are collecting the first revenues. Have you estimated that what will be the eventual price? Yes. Within the team, to what extent has the business plan been prepared? I have no idea of the business plan. Are you aware of possible support available? I know at least one person involved in business opportunity development, IP production, entrepreneurship, commercialization. So looking at these last 11 questions from the financials. Now, always, I would like to come back to PowerPoint and make this exercise finalized. Okay. Okay, always using the same Slido. Critical points identified in the financials. Always looking at the potential supporting the startups for investment readiness. Okay, not having a business plan. This is a bit red flag because again, as we discussed before, if you're looking for risk capital investors, you need to have business plan. There's a room, so they need to work around it. Not all financial needs evaluated. Well, I think that established with an external expert the need, but again, as before we discussed it, maybe relying only on external experts, it's something not smart in this stage. Action plan on fund utilization. Yeah, this is something that is true. It's important that when you are going in front of investors, you are having an understanding, a clear understanding on how using the funds that you would like to raise. Other things that you would like to highlight? Be just waiting for the last two participants typing. Yeah, there is also the pricing that the solution that has been done only internally. That again is always something that a suggestion. Try to push the startups talking with early adopters. Yeah, financial projection. Yeah, maybe it's part missing because the business plan is missing. So again, if you need to set up a data room and you don't have a business plan, it's something, the first cornerstone that you need to solve. So yeah, this is the main, I would say, red flag around the financials, and not clear about how to use also the fund they're looking for, which is again another crucial point when you are interacting, pitching to in front of investors. Okay. Then I don't know if before closing you would like to write comments, recommendations that you would like to give to these startups. So maybe the main one, or just the main kind of thing that you will work around with this startup. So after, I would say, looking at this BOSAT, after you analyze this BOSAT, which would be the first action that you will move with this startup? How you will support as first action, being an expert? The first one that you will do, just again, always for sharing your thoughts around. Yeah, team commitment. Yeah, would be a very good point. This one about the team. Yeah, absolutely. Someone else? Okay, see another one is typing. Yeah, of course the team. That it's something crucial. So working around how to bid in properly and stress this point of the team, not making it as a hobby, but as a business opportunity. And we have, okay, now we have someone typing down. So maybe we can just wait them and then we can go for conclusion. Financial document preparation is another good point. Yeah, absolutely. So if you're raising money, go fundraising, you need to have financial projections. Also the EP, yeah, to clarify this point of the EP, it's something relevant because intangible assets are crucial for investors. Adapting, I don't know, does it mean maybe exactly, but I would say thanks for sharing these 4 thoughts and for participating in this exercise. I hope that you can make a good use of this tool that I will share with the BIC Africa team, and then of course they will share with you. Then I would say that's it. We are perfect on time, I would say. So I don't know if there are questions, doubts on the meanwhile, or something that you would like to ask before closing. Otherwise, I will give the word for the conclusion to maybe Christina or Douglas or Robert.
Thanks a lot, Lorenzo. Thank you for the great and very useful session. So also, I think some participants asked in the chat about the materials. So as for the previous sessions, we will share the materials by email and also through the website and our YouTube channel. Douglas, Robert, perhaps I pass over to you for a few words, but again, thanks a lot to our experts and thank you to all the participants for being in this session, and also if you attended the other sessions. Thank you.
Douglas, please go ahead.
Yes, for me, just to repeat that, to say thank you to everyone. Thank you, Lorenzo. Very interesting use of the model. Really practical tool. I think it's very interesting indeed. Thank you to all the participants for the interactions as well, especially in the final part of the session. I think that's very appreciated and really helps to close the session well. So thank you to you all. again, thank you to everyone who has been in either 1, 2, 3, or 4 of the sessions this year, and we're looking forward to running new sessions next year as well. Robert, to you.
Indeed. So again, just to say thanks to all the participants, especially those who stayed on for the last session. I know it's a long time today, 4 hours, but I thought that the exercise at the end was very useful in particular. So I hope you could get some great takeaways from that one. And indeed, please do follow us on the BIC Africa website, all our social channels as well. As Douglas just mentioned, we'll be doing some more online training open to everybody next year as well. And we'll be giving some more updates, some other activities we're running out for BIC Africa in the coming weeks and months. And of course, as the Christmas and New Year is not so far away, from everyone on the team, we wish you a very happy Christmas and a happy New Year as well. And we look forward to reconnecting in 2024. And finally, thanks again, Lorenzo, for doing a great presentation over a long time this afternoon. You must be exhausted, so have a nice rest. And we look forward to seeing you all again very soon. Thanks very much.
Thanks, everybody.
Thank you.
Bye.
Thank you. Bye.
Bye for now. Bye-bye.